I'm curious how you would assess the health of the startup community more broadly right now, and also the VC dollars that we've seen flowing into it. Do you expect to see a halt or at least some sort of slowdown in that right now? For example, is it changing the way you're investing?
So in the sequence you raised the questions, Morgan, first, as we've discussed in a couple earlier sessions, there are not enough startups going on in the U.S., and they are not across enough states to generate the 25 to 30 million jobs we're going to need in the next decade, because they will be the innovation engine and the job creation engine for this country. So we were already at about half what we needed. In terms of the venture capitalists, I've already talked to many of my friends. They're kind of going to pause here and watch to see where they invest and where they don't. There's plenty of cash in the market, but the problems will be those companies that were marginal before will have a lot of trouble getting funding. And so this is where if a company was, as a startup, only focused on growth and did not have a clear plan to profitability and a clear plan to free cash flow, they'll have trouble raising funds. So one of the messages that I liked out of the president's message last night, for small business, we've got to free up this money. The venture capitalists will fund those that are really in good shape, and they'll probably stick within their portfolio. But I think a little bit of caution is going to occur here. Myself, I gained market share during the downturns. 1997, the Asian financial crisis. As painful as 2001 was for us, and I made mistakes, we made all our changes in 51 days. Day 52, we started gaining market share before our peers even moved. 2008, we saw it coming. We extended credit to automotive companies, as I said before, and we built relationships which lasted for life. So this is when leadership has a chance to really lead. Jack Welch, who I admire greatly, and I was so sorry about his passing, he called me up after 2001, and he always kidded me about just having a good company. He said, "You finally have a great company." And I said, "Jack, I don't. I'm getting killed by my investors. I've let people down. I had to do layoffs." And he said, "No, this was actually your best year." And I said, "You're going to be the only one that will ever tell me that." And he was. Shimon Peres said it a different way. Leadership is during challenges.
The value of experience, indeed, John, and you've had plenty of it. John Chambers, great to have you with us.
It's a pleasure, guys. Thank you for having me on.
Well, it's time now for ACNBC News Update. Sue Herrera has that for us back here at HQ. Sue.
Indeed, I do, Morgan. Thank you very much, everyone. Here's what's happening at this hour. Italian newspaper headlines are declaring Italy closed. New restrictions have now gone into effect, shuttering all stores except food shops and pharmacies. In Rome, streets are nearly deserted with just a few people wearing masks. India has now temporarily suspended visas for all non-essential travel to that country in a bid to halt the spread of the coronavirus. So far, India has reported just 73 confirmed cases, no deaths from the virus. China says its coronavirus epidemic has passed its peak. The country reported only 15 new cases and 11 deaths today. Another 1,318 people have recovered from their infections. And here at home, tours at the White House and Capitol Hill have now been suspended due to the growing spread of the coronavirus. Access to House and Senate offices will also be restricted. We will keep you up to date. That's the news update this hour. Carl, I'll send it back downtown to you.
All right, Sue, thank you very much. A lot of more live events are getting canceled to curb the spread of the coronavirus. Event organizers and now insurance giants are poring over their policies to figure out which costs are covered and which ones are not. Our Contessa Brewer joins us with some answers. We heard Mark Cuban talk about this morning.
Yeah, it's really remarkable when he just says, no, we've looked at it, and our insurance just doesn't cover what's happening with canceled games. Washington State, Ohio, San Francisco have banned now large gatherings, massive conferences, coast to coast, already canceling. Austin, Texas declared a disaster. South by Southwest then got called off just 1 week before it was supposed to take place. That festival says it will be on the hook for tens of millions of dollars because its insurance policy does not cover that. Lots of others in the same boat. In fact, Washington State's insurance commissioner warns on the website, event cancellation insurance does not kick in unless the organizers bought a special rider that covers communicable diseases. Now, experts from Marsh, the global insurance broker and consultant, tell me companies will find if they canceled proactively, that is, they canceled out of fear of coronavirus, the policy likely would exclude that cancellation. And this designation of pandemic, so what? Big deal. Doesn't change anything except where it's going to motivate the civil authorities to then ban large gatherings. Those orders coming down from city governments or the state are what initiates the coverage. Want to drill down some more here? If you need to examine your insurance policy details now and look at whether you took out the rider, act fast, mitigate those losses, file your claims ASAP. And even if you have the most comprehensive policy, your insurer will expect you to minimize your losses by acting sooner rather than later. And also do the right thing. Alex Roger of Lathrop GPM tells me, do not let your insurance coverage dictate how you act. Because if you fail to act prudently, you could find yourself liable for additional costs down the road. For instance, your company could be sued if someone contracts coronavirus at an event. They argue that event should have been canceled. Or if shareholders file a lawsuit claiming that directors and officers failed in their fiduciary responsibility, we could see D&O insurance guys coming into play there as well. But look, in Las Vegas this week, one of the biggest conferences that they have
kept going.
ConAg, right. It's on, and they say that they've only had about 1% to 2% of vendors or exhibitors pull in this case. So you still have a lot of people mingling in large places.
If you're a ticket holder, what's your recourse if the event is canceled?
Pretty much nothing.
So refund policy is non-existent.
There's not a lot of appetite for refunds in these cases because, as like South by Southwest said, we're on the hook for tens of millions of dollars. Now, you have some events saying, we're going to look at that policy. We really care about your partnership. They may say, we're not going to give you a refund, but we'll already pay your membership for next year's conference and try to work it out that way. The venues in this case are largely protected because they get the deposits. The cancellation fees usually equal what they expected for profit revenues. So a convention center is not going to be on the hook for this. It's going to be the event organizers. And then, the suppliers, the vendors, the exhibitors, they're not going to get their badge fees back. They're not going to get the exhibitor fees back. And whatever they paid to truck out signage and equipment and whatever, out of luck.
Yeah, Contessa, I mean, the losses could be really stunning here. And I know we're talking about events right now, but you can also talk about something like business interruption with some of the impact from supply chains, or if a company has to close down temporarily because of coronavirus, travel insurance, it could go down the list. It's pretty amazing. And I think a lot of it harks back to SARS, the fact that the insurers are not offering this type of coverage. It almost reminds me of flood insurance or hurricanes. I wonder if there are already starting to be conversations about some sort of coverage now moving forward in the future, given what we're seeing playing out with coronavirus.
The interesting part of this, Morgan, and you know this as well as I do, again, with business disruption insurance, you're only going to see that that's going to come into play if there's a covered event. So if you have a coronavirus in your workplace and then you have to close down your workplace, so your customers no longer have access to your workplace, you may see your business disruption insurance coming into play then. You can claim the cost of disinfecting your workplace after a coronavirus case, but can you claim those to your insurance protectively? Maybe not. And a lot of this is a case-by-case basis. You're going to see, and we've talked about this before, a spike in lawsuits that result from an insurer saying, no, we don't cover that, and the policyholder saying, yes, you do.
No, there's going to be definitely a demand for lawyers. The president's on the tape now saying maybe the Olympics should be postponed for 1 year. Hard to imagine holding them without spectators, which would be the mother of all cancellations. Not happening yet.
There are so many people who will be on the hook for the Olympics. And we know that, for instance, the big broadcasters have plans in place for something that would happen that would take the Olympics off the air for a long time. But how those policies come into play when it's because of a communicable disease, it's interesting.
Interesting story. Thank you, Contessa Brewer. I think we're going to check. Well, markets close to session lows, down 2,000 points once again. We did trigger that first circuit breaker shortly after the open. And we are waiting for the president's playback tape to get to us. Eamon Javers monitoring some of the headlines we've gotten, Eamon, over the past few minutes on gas prices, the market, the Saudi prince, and more.
Yeah, Carl, that's absolutely right. The president is talking about the Olympics here, suggesting that if they do cancel the Olympics, maybe they should just be postponed and played 1 year later. The president also sort of talking with the Irish Prime Minister here about the feeling that we all have as we go about our daily lives and shaking hands. The president saying that he did not shake hands with the Irish Prime Minister, and he did not shake hands on his visit to India recently, although, he has been shaking hands in public and on camera recently. He said, it's this strange feeling of, do you shake somebody's hand? Is that rude to shake somebody's hand right now? The vice president said earlier this week that he and the president are going to continue to shake hands, even with this outbreak of the virus in the United States, because they're politicians, and that's what politicians do. But the president clearly personally grappling with this, even as the administration continues to grapple with it. The Washington Post just reported that a Brazilian official who was photographed standing near the president and the vice president in Mar-a-Lago has now been tested positive for COVID-19. So that brings it one circle of connection closer to the president of the United States himself. Earlier this week, we were told that the president had not been tested for coronavirus. We don't know if that has changed in recent days over the past 48 hours or so. But clearly, this is a president who is grappling with the impact of this on himself in terms of those superficial social interactions, and then also the impact of it on the nation itself, Carl.
Amy, he did talk about his motivations behind the travel ban that he announced last night. He does add that domestic travel restrictions not being discussed, but could be possible if there are hotspots around the country.
Yeah, the president has resisted any idea of domestic travel restrictions. He has viewed this, as he said last night, as a foreign virus, something that's coming into the country from the outside. So he's been amenable to the idea of closing off certain travel from China, of closing off certain travel from Europe, as he did last night. But he views this as a failure of foreign leaders to fully address this issue, and he wants to address it that way. The question is, will he pivot on that and start to respond in terms of travel inside the United States? No indication that's happening yet. The president has not yet declared a national disaster or a national emergency. And according to what we're seeing out of this meeting, we'll see it on tape here in a few minutes. He says he doesn't see a need for that yet. So this is a president who is toggling back and forth, Carl, from a need to sort of minimize this, to not indicate to the American people that there's any need for panic or fear, and also reaching for dramatic big gestures like proposing this payroll tax cut of $1 trillion and then saying he's going to have dramatic and major economic stimulus ideas early in the week, not proposing those late in the week. In last night's speech, we saw simply small business association loans, and small business administration loans, and Treasury Department actions, that sort of thing, as opposed to sort of massive economy shifting policies coming from this White House. So the president is sort of toggling back and forth on how he wants to handle this. How big does he want to go here? And it seems a moment of uncertainty here at the White House.
Yeah, Eamon, has the White House made any effort to reconcile the different messages that have come out over the past several days about this virus? On the one hand, comparing it to the flu, implying it's not that serious, saying that it's not a financial crisis, but then saying that they're contemplating measures that one would take, fiscal measures to combat a financial crisis, and talking about this as a serious disease in two different breaths, two widely different messages. Has the White House made any effort to reconcile them?
No. I mean, the White House is sending multiple messages at the same time through sometimes the same officials, and there's no effort to reconcile that at this point. I mean, the messaging has been all over the map here. I've been trying to get detail, just for example, small thing, but just been trying to get detail through the morning of the details of the Small Business Administration proposal and the Treasury Department actions the president laid out. And folks at the White House just have not been able to offer that, have not offered that to us. So
Lloyd Blankfein, Eamon, with a good tweet.
Sure.
Good risk management at this point. Go all in on social separation and all in on financial relief to the most vulnerable. Save the second guessing for later. I would welcome if we look back 3 months from now and think we overreacted. That's Lloyd Blankfein weighing in just about 20 minutes ago. We'll get to the president.
You're losing all of the revenue for the teams, the vendors. I mean, it's that way all through the entire economy.
Yeah, it has an obvious effect. The only thing worse can be that you lose thousands and thousands of people more than you would have lost if you did it the way we're doing it. So it certainly has an impact. And again, we're very much working with the states because, you know, the states are a smaller form of government. They can control individual arenas and individual things better. And it's different for different areas. Some areas have no problem whatsoever in our country, and others do. So we're working with the governors of the various states, and I think it's working very well. I think the relationship has been very good with California and some others that in particular have been hit.
Mr. President, it looks like you'll be facing Joe Biden now in the presidential runoff. Are you happy that he?
Yeah, I'm happy. Whoever it is, I hope they make their choice soon. I thought it was going to be, everybody thought it was going to be Bernie. And I've said Elizabeth Warren, if she waited she waited that extra 4 days, and Super Tuesday was a disaster, he would have won every one of those states, or almost every one of those states. Maine, Massachusetts, Texas. You take a look at the states that were very close, and many of her, I would say most of her, I would almost say all of hers, but many of her votes would have gone to him. So had she left prior to Super Tuesday, which just a few days, he would have right now been declared virtually the winner. It would have been over. But now we have Joe, and I'm very happy to run against Joe.
Mr. President, you have both of your chiefs of staff
one of the reasons I ran for president is because of Joe and the job they did. So it's one of the reasons.
Mr. President,
in a way, it's maybe the way it should be. But it looks to me like it would be Biden would win.
Are you considering
any travel restrictions within the United States, such as to Washington State or California?
We haven't discussed that yet. Is it a possibility? Yes. If somebody gets a little bit out of control, if an area gets too hot, you see what they're doing in New Rochelle, which is good, frankly. It's the right thing, but it's not enforced. It's not very strong, but people know they're being watched. New Rochelle, that's a hot spot.
Just a separate topic. You spoke to the Saudi Crown Prince the other day.
I did.
What did you tell him about the oil market?
Well, I asked him what's going on, and they're having a dispute with Russia. This is something that drove oil prices down, and one thing I can tell you is oil prices are at a point now that I would have dreamed about, because the gasoline prices are going to be coming way down. They'll be coming way down. So with gasoline prices coming down, that's like a tax cut. Frankly, that's like a big tax cut, not a little tax cut for the consumer. So there's something about that I like. Thank you very much.
Mr. President, let go.
Thank you very much.
Mr. President, we're finished. Let's go.
Is this your first day?
Guys, we're done. Finished. Let's go. Make your way out. Press, let's go. We're finished.
All right, that is the president. Obviously, comments there about gas prices, domestic travel, explanations for the move last night regarding the travel ban from Europe. In his words, saying that he didn't have time to consult with EU officials and exempted the UK because, in his words, they are doing a good job controlling the virus. The EU did have a statement late last night and this morning. The EU is disappointed about the decision that was taken unilaterally and without consultation. In their words, the coronavirus is a global crisis and it requires competition rather than unilateral action. All right, so Eamon, with all of those comments and also commenting a bit about his own campaign scheduling plans, which to varying degrees appear to be somewhat on track.
Yeah, that's right. The president has canceled trips to Denver and Las Vegas, I believe, over coming days here. But he's been adamant that he wants to be out on the campaign trail. He wants to continue to hold those rallies. Those are important parts of his effort to rally his base going into November and build that broader base of support that he's going to need to win re-election. But they're going to have to take into account the spread of the virus and the guidance of state and local officials. And you saw the president there suggesting that he does want to leave it up to the states. He views the states as being the appropriate place to handle this because there are different hotspots in different areas. Although he said in response to that question that he could consider some domestic travel restrictions if things get too hot. No indication of when that would be coming or on what basis that decision would be made. But the president seeming to open the door there, Carl, I think, for some domestic travel restrictions as well as international.
All right, Eamon Jabbers, for now, thank you.
You bet.
And let's bring in Samantha Azzarello, J.P. Morgan Asset Management's global market strategist, along with John Stoltzfus, chief investment strategist at Oppenheimer Asset Management. Guys, good to have you.
Good to be here.
Things moving fast. John, the president just made some comments about oil. Talking to MBS, the Saudi Crown Prince, and really just talking about oil from the standpoint of low gasoline prices being like a tax cut. There are a number of people who we've had on our air who expect the president, the White House, to push some sort of fiscal stimulus to boost the oil markets and to perhaps end up getting prices higher. Does this perhaps pull the rug out from under those hopes?
Not necessarily. I'd say just based on the unconventional style of the president, and this looks like a decision in flux. Maybe some of his advisors giving him other opinions that are flowing through the administration. I don't think anything's in stone right now. Everything's in a state of flux.
And so, Sam, I wonder if that means that we can expect the same style of communication that we've been getting out of this administration. I was just talking to Eamon Javers about the wildly different commentary on the virus that we've gotten. On the one hand, it's like the flu. On the other hand, it's very serious. On the one hand, this is not a financial crisis. On the other hand, we're going to respond to it as though it is. Is that where investors are stuck?
I mean, it's very clear that market participants are fearful right now. All you have to do is look at the 10-year yield. I know we always look to the VIX, but I actually think the 10-year yield is a much better representation of how people are feeling. And obviously, they're not feeling very good. So I do think when we look at the administration, right, what we need organization and we need coordination. So we know we need fiscal stimulus, and we would argue tax credits, great in the long run, but right here, right now, we need something that's more immediate in terms of relief to settle things down and make people feel like there's support for markets and for those who are going to be impacted by the virus.
So what specifically?
Well, what comes to mind is obviously paid time leave for those who are service workers. What also comes to mind is backstops on the credit side for small businesses. I know we've heard some inkling of that, but we'd like details. We need details right now. And I would argue more coordination around just messaging to the public.
Yeah, I was actually going to pick up on that same exact thread with you, John, and ask how much, at least from a market perspective right now, does hinge on some more robust details around possible fiscal stimulus, especially given what we're seeing play out right now in Congress and the fact that lawmakers are still, as of right now, poised to go on recess next week.
Yeah, Morgan, it looks like to us that the market is very much protesting the lack of anything specific coming out of Washington in terms of dealing with this. And it's also very quickly to respond in showing by its actions of how it feels about it. I mean, when you consider what it did after Jerome Powell had cut interest rates, it showed it didn't like that. And yesterday, after the president was speaking from the Oval Office, the feeling was very clear that the market was unhappy with it. And I think it's a matter of getting their hands around this thing and coming to an agreement. We need one of those moments where somebody says the only thing to fear is fear itself, and behind it there's a plan that is outlined, I think, very specifically. But it takes time, regrettably, and this is an occasion that we haven't really seen this. We've seen a lot of viruses, but not one to this extent that has spread this much. One that has spread also as quickly, the acceleration of it. But the good news is, that usually these things do come to pass, and that's what we're looking for here.
Indeed, to that very point, John, here's the president once again moments ago.
The obvious, and we'll also be talking about the virus that's hit the world. I see they've canceled their big soccer games, their championship games, and a lot of other games. They've canceled a lot over in Europe and all over the world. So this is a big world problem. We've taken some bold steps. We took the original boldest step of all when we closed very early with China. That helped us save thousands of lives. And we went very early with Europe. And I think that will likewise be very good. And hopefully we can get it back together very quickly in terms of reestablishing with China. That's on track to something happen fairly quickly because they've made a lot of progress over the last 3 or 4 weeks. And certainly with Europe, we think we can go hopefully very quickly. They have some hot spots that are really bad, but they'll get them better. Germany, I guess, has some problems now. France has some problems, some pretty big problems. And Italy, of course, is probably record-setting in terms of what they've gone through. Italy's having a very hard time. But we think we'll reestablish very quickly once this ends, and it's just a question of time. And I think it'll go pretty quickly. Stay away from people and wash your hands and do all of the things that we're supposed to be doing a little bit anyway. But it'll go very quickly. I know that we were just talking that Ireland's closed their schools, and maybe I'd ask the Prime Minister to say a little bit about what you're doing in Ireland having to do with what we're going through.
Well, first of all, thank you, Mr. President, for having us again here today, and going up to St. Patrick's Day. Just another opportunity, I think, to show how close Ireland and America are, and how good our relationship is politically and economically and everything else. And St. Patrick's Day has become, I think, a symbol of how close Ireland and America are, and how we're going to continue to stay close into the future. The big concern in Ireland and Europe at the moment, as you know, is COVID-19, and we've acted, just as you've acted decisively in the last couple of days. So we have restrictions on travel, for example, to Italy for a few days already, but as of tomorrow, our schools will close, our creches will close. We're banning all indoor gatherings of more than 100 people and outdoor gatherings of more than 500. This is all based on the public health advice from our CDC that we need to do this for a couple of weeks to make sure the virus doesn't spread. And we're particularly trying to protect older people and people with chronic diseases. So we've had about 30 or 40 cases so far, one death. We were real concerned that could rise, and that's why we're taking the action that we're taking. But as you know, it's a virus that's gone pandemic. It's all over the world, knows no borders, knows no nationalities, and I think we all need to work together in the world on this. And America in particular, you're the richest country in the world. You've got great scientists, great companies, great universities, and we need them working on treatments, working on tests, and working on a vaccine, because that's what will get us on top of it.
And we're making great progress there, I will say.
I was with the Vice President this morning, who I know is heading up the task force for you, and he gave me a lot of confidence that you're getting on top of this and investing.
Right.
Mr. President, can you confirm that Ireland will be excluded from your travel ban, that your European travel ban you announced last night?
Well, they know, and I think it was made very clear last night who is and who isn't. We'll be discussing that. We'll be discussing some of the moves that we're going to be making, and I think it's going to work out very well for everybody. But it's a world problem, and you do need separation in some cases. You have some areas that are very heavily infected, and you have some areas that aren't, frankly. But we do need separation for a little period of time in some cases.
What about the stock market? Just saying that the President has excluded Ireland from the travel ban. And one of the things we have in Ireland is CBP, American Border Security in Ireland. Went through it myself yesterday, and they were asking the right questions, whether people had been to China, things like that. So that puts us in a slightly different position.
And one of the reasons UK basically has been, it's got the border, it's got very strong borders, and they're doing a very good job. They don't have very much infection at this point, and hopefully they'll keep it that way.
Mr. President, there are many European leaders who are upset that they weren't consulted about the travel ban. Can you explain your rationale for not consulting with them first before announcing it last night?
Well, we get along very well with the European leaders, but we had to make a decision, and I didn't want to take time, and it takes a long time to make the individual calls, and we are calling, and we have spoken to some of them prior to, some of the majors prior to. But we had to move quickly. I mean, when they raise taxes on us, they don't consult us, and I think that's probably one and the same. They've done things, the European Union, as you know, has done some very big tax raises over the years, not so much with me because I won't put up with it, but they haven't consulted us. And in the case of European Union, I've consulted with many people.
Do you have any idea what the overall economic impact of these travel restrictions?
Well, it'll be a big impact, but it's a bigger impact, and it's also a human impact, which is more important, frankly, than the financial. When you lose thousands of additional lives. As an example, if I didn't close very, very early, Leo, we closed very early with China, and I took a lot of heat, including from you people, a lot of heat. They called me everything from a racist to everything else. It was terrible. And the same people, then they say, oh, he closed too fast. Why did he close? Most of them said, why did he close with China? That turned out to be a great move. What we did with Europe is this was the time. And China, a lot of it came from when you think of what happened to Europe, because it was very fast and very furious. And what happened is a lot of people went from China into Europe, and Europe suffered tremendously. You see what's going on. And so I just wanted that to stop as it pertains to the United States, and that's what we've done.
What are your plans, Mr. President, about campaign rallies, about travel outside the White House? You originally had some travel on the schedule.
I did. We had some big rallies. We canceled one that we were thinking about doing in Las Vegas, as you know, and one in Reno, Nevada. We had one. We had about 3 of them in Nevada, actually, and we had 4 or 5 of them that we were thinking about. We have a big one in Tampa, all sold out. We have over 100,000 requests for tickets, but I think we'll probably not do it because people would say it's better to not do. You know, we need a little separation until such time as this goes away. It's going to go away. It's going to go away. I was watching Scott. I was watching Scott this morning, and he was saying within 2 months. But you know, in the meantime, we want to lose as few people as possible. So important. And what is the number as of this morning? Is it 32? You can tell me. Is it 32 deaths? Steve, around that. I mean, think of it. The United States, because of what I did and what the administration did with China, we have 32 deaths at this point. Other countries that are smaller countries have many, many deaths. 32 is a lot. 32 is too many. But when you look at the kind of numbers that you're seeing coming out of other countries, it's pretty amazing when you think of it. So that's it.
Are you going to invoke the Stafford Act today, the declaring of
We have things that I can do. We have very strong emergency powers under the Stafford Act, and we have it. I mean, I have it memorized practically as to the powers in that act. And if I need to do something, I'll do it. I have the right to do a lot of things that people don't even know about.
Are you going to do that today?
Well, I don't want to say that, but you know, at some point, it may be some of the more minor things at this point. But you know, look, we're in great shape compared to other places. We are in really good shape, and we want to keep it that way. That's why I did the ban with respect to Europe.
Emergency actions that you can take last night.
I have a lot of emergency actions that I can take.
Workers.
Yeah.
What are you looking at to help American workers?
Well, we're looking at a lot of things, including paid leave, and we're looking at many things. We're also making sure they're going to get their salaries. We have other workers, too, and those are people that work for tips, and nobody thinks about them, and we're including them in a lot of our schedules. We're also making sure that the companies, which are good companies, stay solvent, have the money necessary to keep functioning. So we have a lot of things that we're working on with the financial markets, and it's going to work out fine. You know, you have to remember the stock market, as an example, is still much higher than when I got here, and it's taken a big hit, but it's going to all bounce back, and it's going to bounce back very big at the right time.
When will you decide, though, for the American workers, what steps?
Well, we're deciding right now, and we're dealing also, prior to even the Stafford Act, we're dealing with the Democrats in Congress. We'll see what can be done. I happen to think that a payroll tax cut would be a very good idea. Very distributes it, really distributes it very evenly among middle class and other workers. I mean, many workers. It would be a great thing. I happen to think it would be a great thing even beyond this, okay? So we're looking at the payroll tax cut, and that won't come immediately because that's a stronger measure. But we are looking to do that, and I think at the right time, Congress will probably go along with it because it really is the most sensible thing. We had the biggest bankers in the world here yesterday getting their opinions. They all thought payroll tax cut would be a great thing. It would evenly and quickly distribute a lot of money.
Do you support the House bill, the House Democrat bill?
No, because there are things in there that have nothing to do with what we're talking about. So, you know, it's not a way for them to get some of the goodies that they haven't been able to get for the last 25 years.
Will our citizens always be welcome to America?
Always. Just like your prime minister, always. They will be not only welcome, loved. We have millions. What is the number now, would you say? It changes every year. It gets actually bigger.
Yeah, well, about 35 million are.
Yeah, can you imagine?
Irish.
It's got to be one of our. It's got to be one of our biggest. Now we love the Irish.
Do you support Irish citizens getting access to the E3 visa?
We're going to be looking at that. We're going to be talking about that today. It's a very important part of our conversation. That's going to be actually a very important part of our conversation today.
Are there concerns about Huawei, Chinese telecom company, and its operations and connections with countries like Ireland? Is that going to come?
Well, I think there's a lack of security. If they use Huawei, there's a real problem with intelligence and intelligence security. And we'll see what happens. We'll be discussing that point also.
Mr. President, can an American still bring back coronavirus under this new travel restriction?
Can I what?
Can an American still bring back coronavirus?
Sure, but we have them very heavily tested. If an American's coming back or anybody's coming back, we're testing. We have a tremendous testing setup where people coming in have to be tested. And if they are positive and if they're able to get through, because if they're not, we're not putting them on planes if it shows positive. But if they do come here, we're quarantined. It's going to be a pretty strong enforcement of quarantine. Look, the key is you have to have separation. We have to have separation or this thing takes longer to go away. But the really important, and I think you can say this for your country, I think we can say it for a lot of countries, for all countries, hopefully, it goes away. It's going away. We want it to go away with very, very few deaths. People have, we call it cases. How many cases do you have? Well, relative to other countries, we have very few cases. Relative to certain of the major countries that really have a bigger problem than us. We've offered just interestingly, I think we have the greatest doctors in the world. We've offered Iran assistance. Iran is having a tremendous problem. And we have offered Iran assistance. If they'd like it, we will help them. We'd be glad to help them.
Speaking of Iran, Mr. President, the Pentagon has determined that an Iranian-backed militia fired the rockets that killed 2 American soldiers in Iraq. Yeah. Should they expect a response?
I'd rather not say, but let's just put it this way. You will see.
Mr. President.
Okay? But I can't say. I was working on that last night also. They sent a lot of rockets now. That hasn't been fully determined. It was Iran, as you know. It was a rebel group. But most likely looked like it could be backed by Iran. And we'll see what the response is.
Mr. President, would you like to see the Prime Minister return to the White House next year? He's trying to form a government at home. Would you like to see him back as Prime Minister?
He's a friend. I always want him to return because he's a friend. We've been doing this now for quite a while. We started off both new to the job. And, yes, I would always like to see him. I know they have other people that I know and I get along with very well. Look, we get along with the country, but this is a very special guy.
We'd like to see you back in Ireland again for a longer visit, I hope, next time.
Would you like to see Mr. President re-elected in November?
That's of course a matter for the American people, but President Trump and any American president is always welcome in Ireland.
Mr. President, there's a report that a press aide to Brazil Bolsonaro, may have the coronavirus. Are you aware of that? Because you were in contact with that person over the weekend.
I did hear something about that. We had dinner together in Florida, at Mar-a-Lago, with the entire delegation. I don't know if the press aide was there. If he was there, he was there. But we did nothing very unusual. We sat next to each other for a period of time, had a great conversation.
All right.
He's doing a terrific job in Brazil.
And I want to welcome you to the halftime report. I'm Scott Wapner. We have been watching the president there in the Oval Office with the Irish Prime Minister speaking about coronavirus. And like the rest of us, watching this stock market, which right now is at the lows of the day, down. The Dow is by more than 2,100 points. The president saying of the stock market, the markets will bounce back in a big way. Still a lot higher than when I got here, he said. As for what sort of fiscal stimulus may be on the way, the president saying he opposes the House coronavirus bill, talked about falling gas prices, called them like a tax cut, said he is not considering a domestic travel ban at this point in time. He is not yet invoking his emergency powers, but saying, quote, I have a lot of emergency actions I can take. I should also let you know that in the last few moments, the director of the CDC has now said that the virus is in 44 states as well as Washington, D.C. That's from a congressional hearing, so worth noting what the latest numbers may be and the spread of this virus across the United States. I have everybody here with me today. It's an all-hands-on-deck kind of day. Yet again, our investment committee, Joe Terranova, Jim Lebenthal, Steve Weiss, our CNBC contributor, Ron Insana, CNBC's Jim Cramer. He's the host of Mad Money at the New York Stock Exchange. Jonathan Krinsky is back with us of Baycrest Partners. He's their chief market technician. Also with us on the phone today is Tony Dwyer, Canaccord Genuity's equity strategist, their chief one. I told you at least what the markets are doing. We'll show you once again. 21,416 is where the Dow is right now. That's a loss of 9%. Stocks plunging yet again today. So, Jim, I turn to you first. The market clearly is not getting what it wants. whatever that is.
Right.
What is going to stop this now?
Well, I'm not sure it can be stopped just because we now have so many companies that I think are going to be strapped. That a recession certainly, if not on the table here right now. I know, look at our guests who've been here before. We remember the day, Terrible Tuesday, the day after the crash, we did have the Federal Reserve come out and say they'll make all liquidity necessary. I certainly think that that's reasonable. That was a one-line statement, and it made it so that the market was able to open at least. I do think that, I know the president is calm, and that's great, because we do want calm heads. Obviously, with this, there were less rancor, but how about $500 billion Treasury issue? Yes, it needs Congress. Almost no interest costs to be able to make sure that when people are sick, they don't have to go to work. And companies that are really in trouble because of that can still make their payroll. How about a credit line backstopped by, instead of having just be a run on every single bank, by the Federal Reserve? I know the Federal Reserve say you can't do that. I know Congress can't do it. Everyone is going to say what they did in 2007. I can't do that. I can't do that, until they did it. But it was too late, and a lot of people lost their jobs. Why not suspend the buyback rules? Have them go all day. Why not have funds to tide over with that $500 billion money so that companies can make their payroll? And then, look, I know the president likes the lower oil price, and that's good, but he should still try to fault the Strategic Petroleum Reserve, maybe put a floor on oil because of all the companies that are in trouble. Those are just some ideas, kicking them around. But what's really important is that we don't get into a mode where they tell the press, we can't do that. No, that requires this, that requires that. Because we heard all that already. We did that in 2007. They ended up doing everything.
Are you saying that stocks are not going to stop going down until we get those kind of measures? I mean, everybody wants to know the same question.
Well,
when is this going to stop?
Not all stocks. I mean, I see companies that can be bought, but they're not companies that I necessarily regard as being bedrock companies. I mean, we need to make it so that a Boeing is not in trouble. Boeing got its revolver down. Now, if everybody pulls the revolver down, same time, Steve, then we know no bank can withstand that. Right. I mean, then we're back in that Potter's Field. We're back in It's a Wonderful Life. Yeah. So we have to stop that. We have to make people feel those credit lines are guaranteed so the banks are still willing to do them. And then not only would I want to buy stocks, but I'd be saying, how did I miss that?
So let me do this. Let me bring in Jonathan Krinsky because he has a real good read through the technicals, and he's been pretty spot on over time with this sort of stuff. Jonathan, what do you see that gives you an idea about where we are and where this market may go next?
Yeah, so thanks, Scott. So the last day or two, we've started to see some major capitulations across all asset classes, the likes we really haven't seen since 2008, and in some cases ever. And one example, we look at the risk parity index, which buys stocks, bonds, and commodities and tries to kind of hedge out volatility. And that index on a 4-day basis is having its worst decline on record back to the early 90s. So we're not just seeing stocks down, we're seeing bonds get sold. It's a real liquidity event. But that tells us that that's the capitulation that you need to start to make a bottom. And one of the other indicators we look at, percentage of stocks above the 200-day moving average, got down to 13% yesterday. It's at 8% today. If you go back in the last 30 years, when you hit 13% or lower for the first time in a month, the S&P is higher 9 of 10 times for an average of about 6% looking at 1 month later. Now, the one case where that didn't work was early October 2008. But I'll note when it hit it in October 2008, the VIX was at 40. We're currently at a 70 VIX. So in our eyes, there's actually more fear right now than there was at that point in early 2008. So to us, this is all part of a tradable bottom. As far as levels, we're looking at 2,700. Clearly, that didn't hold. It's possible we get one more flush and even get all the way down to the December 2018 lows around 2350. We don't think we get that low. We think we're closer to a bottom than not. But those are just some of the extremes that we're looking at to try to find out a bottom here.
Why do you not think we go to those lows? I mean, we remember that time. I remember, Scott, you're talking to Jeff Gunlock, very good theory if things weren't changed. Powell then changed his mind, but that was because we were on the eve of a Fed-created recession. Here we're on the eve of a Corona-related recession. Do you really think that those stocks can't go right back to those levels?
Hey, Jim, anything is certainly possible. Another stat, though, that we look at here, the amount of stocks in the S&P hitting a 52-week low, it's 63% today. It's only been exceeded one other time in the modern era. That was October 10th, 2008. On that day, we had a very similar situation. We were down about 8% in the morning lows. We actually rolled over and made a bottom around 2 p.m., closed the day down around 1%, and then the next day was up 13%, and then, of course, we know we did roll over. So, we're not saying this is the bottom, but we think traders can start to pick at some spots here. And look, we're not ruling out a move to the December 2018 lows, but I think when you start to look at some of the indicators, and look, we're not perma bulls. We'll be the first to say when you think you should get out of the market. I think when there was the most amount of certainty in this market that people would say was January 20 of this year, that was, in fact, one of the worst times to buy. So when there's absolutely no certainty, we think that's when you want to start looking at stocks.
The Dow, Ron, was just down 9.5%, 2,250 points. So how do you see things here?
Well, Scott, when I was growing up in the business, the early days, if you had a 10% single-day decline, we would call that a crash back in the early part of my career. Now it's a little bit more commonplace to see moves, not quite this large, certainly, because this is way outside normal ranges. To Mr. Krinsky's point, well, one thing I would say with respect to liquidity and credit, right, we now have correlations going to one. Everything is being sold off at the same time. I consulted with one of my colleagues at Schroders, Michelle Russell Dow, who runs our securitized debt team, and we've talked to people inside our debt teams across the board. We're seeing illiquidity in U.S. Treasuries. As Steve Leisman was talking about this morning, the bid-ask spread in Treasuries has widened. We're seeing that in mortgage securities. We're actually seeing it in high-quality municipal bonds, which means there are strains in the system. And unless, as Jim suggests, you come in with, he calls it a Manhattan Project, I call it a Marshall Plan, FEMA-like response, whatever it is, it's hard to get close to a bottom when it appears that the federal government and the Federal Reserve are still resisting this kind of kitchen sink approach to putting a floor under the markets and a floor under the economy. Didn't hear it from the president, and I know Jim doesn't want to be critical, but I have to say the speech last night and his comments this morning do not engender the type of confidence you would have hoped for coming from the leader of the free world.
Some will say that the market reaction is backing that view up, for whatever your point of view on that may be. Let me bring in Mark Cuban now, who's joined us on the Newsline, just calling in now. Mark, welcome. There are a number of things I'd like to talk to you about. Sure. Basketball feels sort of secondary at the moment. Yep. I think you understand and respect that. Just tell us just what you're thinking about as a longtime market watcher and participant, and then we'll get to the other side of your life in just a moment.
I'm just as concerned and confused and uncertain as everybody else. I'm a long-term bull in terms of our country, and at some point the markets will be higher. I just don't know when. I dipped my toe in. I bought some Live Nation. I thought it took too big a hit, but I bought it 2 days ago, so I'm underwater there. But like I said, I'm a long-term holder there. I bought some Twitter today. I'm a long-term holder there. I have, I own shares going into this decline. So, I don't know what's going to happen or when, but I think long-term we'll be okay.
So you went through the dot-com bust. Right. You came out good on the other side. We all know that. You went through 08, which people say this bears no resemblance to, and now we're going...
in 08, I killed it. Literally, I was stupid. I bought, at one point, I owned almost 5% of CBS and a couple other companies, and I sold too soon. That was the deleveraging that kind of explained everything. In this particular case, you have oil. We have uncertainty in terms of what the overall impact of the economy is going to be. We went up so fast, like you said. We haven't even got to the December 2018 lows. So anybody who truly has been a buy and hold person, you feel the pain because you look at your 401 or you look at your statements and you think, okay, things are great over the past 12, 13, 14 months. But in reality, we're just back where we were 13 months ago, and we didn't get upset or excited when it went up fast, and we shouldn't get excited when it goes down fast. Yeah, we haven't hit a level that is really out of line.
Jim, to Mark's point, he does. He's obviously sanguine about where we are, but to your point, there are perhaps some stocks out there that don't necessarily have to continue to go down, although he's picking at some areas that are really at the epicenter of what a consumer pullback and a social distancing scenario, and a widening one could look like?
Well, I do think that we do have some companies that don't need a bank to make money, that are AAA. You take a Johnson & Johnson, you can go that way. That's an unbelievable company. It just keeps going lower. It was a great company to buy, by the way, in Monday of 1987. It hung in. I do think that, and Mark, I'd like to hear your view on this. What would happen? We know the federal government gets paid by everybody, every entity, every person. We know the federal government could borrow easily if Treasury and somehow Congress would get together $500 billion to be able to pay the
Jim,
government's
I heard
bills.
what you said this morning, and I think you're right on.
Really?
I even told a congressman this morning that the SBA should be way ahead of this, and there should be money so that any small business in particular can get a quick turnaround $100,000 or $250,000 loan if they don't lay anybody off. Because you're exactly right. Because where this starts to cascade is where you start to see small businesses that can't, you're a vendor for badges for South by Southwest. You're a vendor for, who knows what, boots for the rodeo that just got canceled. You're the one that's going to be most at risk. And when you fire those folks because you can't make payroll or lay them off, then that obviously creates other issues. And that, along with schools being canceled and that creating more stress, and you need to have a backing from the government. Right. I get your point on the big business, but also I think more importantly, small businesses, because they're the ones with the least access to capital.
That's the base of our country, Mark. You and I both know it. And they've done nothing. Yep. They haven't done reckless things. They didn't buy at the top. They weren't taking Tesla at 900. These were people who they are just making payrolls.
So I'm wondering on that note, Mark, the great portion of the population, including our primetime viewership, knows you as a cast member on Shark Tank and an investor there. What are you telling your portfolio companies to do right now? There's, that note that came out from Sequoia last week called this the black swan of 2020 and had some pretty stark suggestions for their portfolio businesses. What are you telling them?
Well, my Shark Tank companies are typically smaller, and so they're more regional in nature. So where you happen to be in a region that's been hit strongly, they've got issues. I mean, I lent one some money this morning, and so I'm gonna just try to help them, fight through it, and hopefully we get through to the other side in 2 months, 3 months, whatever it may be. But that's really what it's going to take, just somebody there to just help them make payroll if that's the case.
You still own a theater?
No, we sold Landmark.
Okay.
But I do own part of a company called RDI. I own some shares there, but I've owned those forever.
Let me pivot to basketball now, if I may.
Sure.
Your look on TV last night, frankly, told the whole story when you were notified about Rudy Gobert. Notified.
I'm going to be a meme for the rest of my life.
Now we know that another player has tested positive as well. How concerned are you about the membership of the NBA right now?
Very. I mean, after our game last night, I went into the locker room. Obviously, guys were concerned. And let me take a step back. Before the game, I went in, and guys were curious about, what the conversations were going on in our league board of governors call. And one of the players asked, if I thought that the season might be postponed or canceled. And I said, maybe there's a 5 to 10% chance of that happening. And then you saw my reaction when I heard it. And then after the game, I was very specific to the players. I'm like, look, this is not time off. This is not like a lockout. This is not the season ending and you just go home and go about your business. You guys are at the epicenter of all of this. You have to effectively self-quarantine. I'm talking to guys this morning, stay inside, because one of the challenges in being, a celebrity, an NBA player, everybody comes up to you, everybody touches you, everybody wants to hug you, everybody wants to take a picture with you. And so you are much more at risk than a typical person would be. And not only that, not only are you at risk of catching it, because you may be asymptomatic because all these guys are younger, you're also at risk of being a carrier because so many people come up to you. And so that leads to two issues. One, we don't want to make things worse in the community. So we're really going to try to keep our eye out on our guys and talk to them and actually keep them busy. The league has said it's okay to continue to have practices and skill sessions and rehab and workouts. And that's going to be important because, it's tough for a 23, 25-year-old guy or person to just sit in their house all day. and self-quarantine. And two, we don't want to be spreading the disease in the community, because so many people come up to us. And so we're going to have, we're going to have to keep track of everybody. We don't, because what would kill the NBA season is, it's horrible that 2 players have it, but for whatever reason, if more players catch it, you have to wait. To be fair, you'd have to all teams. You'd have to wait until those players resolve the virus, and that could kill the NBA season. And so, us being vigilant, and as all businesses should be. We're not the only business that has had employees come down with the virus, and so all businesses are going to have to be incredibly vigilant, and that's hard. And so that really is a personal task. And then there's the task of helping the small businesses around us and the employees that are the hourly workers. I mean, I guess what I'm trying to say is there is a cascading effect in all of this. And those of us who are in a fortunate enough position to try to provide a base, to provide support, we need to do that because, and I'm not saying this as a socialist, I'm saying this as a pure capitalist because it's a smart thing to do because by supporting our communities and keeping them at a steady state or helping them where they need help, we support all the stakeholders around us. We keep business vibrant that way. We help small businesses keep people employed and stay in business. And that helps bigger businesses. So, I'm not a fan of trickle down, but I'm certainly a huge fan of trickle up. And every single CEO, every single entrepreneur, every single person who runs a company, manages a company, has got to be cognizant of the impact of all their decisions. And I think that's an important message, and we try to get that across to our players where they have an impact and to our companies where I'm an investor and wherever else I can get the message across.
No, it's a message that needs to be heard. There are going to be an awful lot of people who are hurting through this and on the other side of it, too. Mark, stay with me for a second. I've got to say goodbye to Jim Cramer. He's got a lot to do to get ready for tonight.
Treasury and Fed working together like in World War II. Right, the Fed has the ability to help us right now with having great liquidity. Treasury can, with Congress, raise $500 billion, make sure that you don't have to pay the federal government, and small business, like Mark said, must be protected, backbone base of the country. I am trying to put this together, this show on the fly, to be honest, and I wish I could tell you who I've had. I've canceled a lot of guests, and I apologize to them. We got to get new ones.
Well, I think we're all in the same boat.
Thank you for the chance, and Mark is so great. What a patriot.
Thank you for being here.
Not a socialist, a patriot.
No, thank you for being here. Thank you. An important moment to hear from you. We'll look for you tonight. So, Mark, let's get back to our conversation. Do you expect there to be a season? Will we finish the season?
As of now, yes, because there's not something that prevents us from extending into the summer. And so it's not like we have a lot of competition for arenas. Maybe the NHL will be in the same position as we are, but the arenas have availability. Television doesn't have other sports replacing us or, preempting us. And so the opportunity is there to extend the season into the summer, yes.
Okay. Steve Weiss has something for you, Mark.
Sure.
Mark, the parallels, people are drawing the parallels to 2008 from this situation, but I don't see them.
Nope.
In April of 2008, the Fed cut rates from 5.25% to 2%. The market continued to go down. In October, TARP was finally approved after failing. The market continued to go down. You look at companies, and I look at companies and say, okay, here's the asset, here's what it's worth, here's what we could forecast. The market's unanalyzable. It's unanalyzable as a completely distressed company. So with that in mind, without knowing the scope of the problem, in 2008, we saw that it was really focused on financial assets, which could be cured. You could identify the cure. Here we have none of that. So to me, I'd look for the market to decline 30%. I don't know why it won't decline another 15 or 20% from here, although I feel like next week starts being a buying opportunity. When you look at...
Yeah, I can't disagree with you, Steve, at all. I mean, look, in 2008, I saw companies that were being deleveraged, and I had cash. I was fortunate that I'd seen some of this coming, and I went in and bought companies that people were concerned couldn't pay their debt and couldn't refinance. So you knew how things would play out, at least to a certain extent. You didn't know when, but you knew to a certain extent. In the end of 2018, we had all the ETFs go upside down, so you knew to a certain extent. Here, what you had a bunch of things, and this is just my opinion. I'm guessing in a lot of respects. We had a black swan event. The one thing algorithms cannot prepare for is black swan events. And so you had a lot of uncertainty there. Then you had what happened with oil happen. So now you have 1.5 black swan events, and so that creates uncertainty. And then you have, the inability to model any of this. And so now we're back to active management, which we haven't seen in a long time. So nobody's quite sure how to deal with this, and so you're still seeing markets trade on a correlated basis, as best I can tell, right? They're moving pretty much about the same percentages except for the Russell. And so because of that, what I've tried to do is look for the outliers. And so I'll use Live Nation as an example again. Why did I buy shares? And I didn't take a big position, but, just wanted to start my position. I looked at Live Nation because, artists still are going to need to get paid, and going out on tour is the primary way that they make money these days. And people are still going to want to be entertained, particularly after having been self-quarantined and cooped up. So at some point when this resolves, whether it's 3 months, 6 months, a year, longer, whatever it may be, Live Nation will be back in the game, and they may even be stronger if smaller competitors aren't able to stay in business.
Drilling down to Live Nation, so you own an arena. Right. And you have a slate of concerts, events, I'm sure, coming up. Have any of those been talked about canceling from the promoters?
Yeah, you know what? I asked that exact question, Steve. Great question. I asked it this morning, and we have 3 concerts that got postponed but pushed back and rescheduled. And so it wasn't like none of them have been canceled yet.
Mark, you got a lot on your plate today. I know you do, and I'm grateful that you spent some time with us. I hope our viewers are as well. Thank you so much. All right.
Appreciate it, guys. Thanks.
Pleasure's ours. That's Mark Cuban. He's the Dallas Mavericks owner, the investor as well. Joe, you've been patient. I appreciate it, too. It's just one of those days.
It is.
Mark has seen some opportunity amid the pain. Do you?
So, again, a lot of being a good investor or a good trader is having intuition. And intuitively, the things that everyone keeps talking about when you're speaking specifically about markets is this rise in correlation. It's at historic levels. You've never seen oil, treasuries, and the U.S. dollar and equities trade so positively correlated. Some of those correlations, and Steve, I heard you talk about this yesterday, some of those correlations are beginning to actually break down. So to me, the sense is that the market actually feels as though it wants to rebound. But the market needs something a little bit more than just the feeling of correlations breaking down and the desire to rebound. The market needs comfort. The market needs a restoration of confidence. Confidence has quickly evaporated. The statistic, Scott, was put out yesterday. Buybacks, which we talk about so frequently, January and February, buybacks were down 46% year on year. That's the biggest decline to start a year since 2009. So on all fronts, and a lot of what Jim was talking about today, we absolutely need coordination, which I talked about at the beginning of the week. We need global coordination. We need the removal of gridlock in Washington, D.C. I'm sorry, I'd rather see Nancy Pelosi and Senator Schumer sitting on the couch with the president today than who was sitting on with him. It was as we saw in the video. Prime Minister. Yeah, I apologize for not
understand your point.
So we need the comfort. We need the confidence collectively. We need the global coordination, both on the fiscal front and on a healthcare front. Because let's remember, we're facing a biological crisis here.
Yeah. So, Jimmy, Ron had some very interesting points of what he was seeing in terms of on the credit side of the table. I think Lebenthal, I think munis, okay? Yeah. From your pop, who was a legend in that industry. Yeah. And that's trickled down to who you are in terms of part of what you do. Are you seeing the same sort of concern within the muni market and through credit?
Yes. And thanks for the intro, not because it makes me feel good, but because there's decades of family legacy here. So, when I talk to bond managers, and I have one who sits 15 feet away from me, he told me just an hour ago, the sell-off in AAA munis, now, we're not talking credit, we're talking AAA munis, is the worst he's ever seen. And across the board, you're talking 35 basis points higher to 50 basis points higher. I see you nodding your head. You know what I'm talking about with a one handle.
Now, let me
finish this. But this isn't about spreads. This is about munis getting dumped. Now, who's doing it? It ain't the retail investor who has been looking at their munis and saying, thank God for my munis. It is banks and broker-dealers who need to raise cash. Now, there's a yin and a yang here, okay? When we see Boeing draw down $13 billion, somebody said it, may have been you, Scott. 13, whatever it is. We see United draw down $2 billion. We see Carlyle saying to all of its constituent companies, draw down your credit line. The cash has to come from somewhere, okay? Here's the knock-on effects. The banks have to raise it. They're selling what they can, okay? Now, in the short run, that's bad because it pressures those gold standard AAA municipal bonds, and it hurts the overall balance sheets of the banks. But here's the positive part. This is exactly the situation that the Federal Reserve knows how to deal with, all right? The great financial crisis was 11 years ago. I see you taking a breath, Ron. It wasn't that long ago. We're not talking about 1987.
Right.
The Fed knows all of its tools that we don't even talk about. Things like the commercial paper funding facility.
Correct.
We never talk about how good that was. That's something they roll out and they start curing funding problems before it gets bad.
Part of Kramer's point, forgive me, Ron, is that we've identified collectively areas that need to be tapped, for lack of a better word, at critical moments. The message needs to get from this microphone, and more importantly, Jim's microphone, because he's the one with those ideas, as are you, with many more years of experience of actually managing money and watching markets. The message needs to get through. The bazooka time may be now.
Well, yeah,
it needs to come at some point because the market is screaming that it needs something more, whether it's part confidence and part actual substance.
Here's a question: if the bazooka still exists, though.
Well, some of it does. Of course it does.
On the monetary side, it
absolutely
does.
And here's the thing. So I did a follow-up call with Alan Blinder. I saw him on CNBC yesterday. I've known Alan for decades, former vice chairman of the Federal Reserve. And I told him that we saw, and Steve Leisman brought this to my attention, and I did some follow-up work with Treasury spreads widening, the bid-ask spread on Treasury securities widening out. He said that is something the Federal Reserve would and should take note of because you're starting to see illiquidity in the single most liquid market in the world. The Fed does have to come in and provide some sort of liquidity facility. The other thing that we saw when you talk about the banks selling munis, we're also seeing internally that banks and clients are trying to sell the same asset at the same time, which means you have no buyer. And again, there's a liquidity gap that materializes.
Hang on a second. You need a dose of good news. You need a dose of good news on days like this. Jamie Dimon is home from the hospital after emergency heart surgery last week. That's per a note from J.P. Morgan to the employees. So we're excellent news. We're good to get that good news, at least if we're dealing with this. And we wish Jamie all the best in the days and months ahead for certain. Let me do this. I know we're all trying to figure out sort of when the market is going to stop going down. I think the other half is when is this crisis of the healthcare standpoint going to abate? Let's bring in Dr. Scott Gottlieb. He's the former FDA commissioner, also a CNBC contributor. He joins us by phone. And Scott, I appreciate you being here. You had a sobering tweet thread today in which you say that we probably, I'm quoting, we probably lost a chance to have an outcome like South Korea. Are you suggesting by saying that we're going to be dealing with this in a more severe way for perhaps a longer period of time? Or why don't you explain exactly what you mean?
Yeah, what I meant is that South Korea did a very good job of turning over cases, identifying people who are sick, putting in place tough mitigation steps to engage in social distancing, to break chains of transmission. And you actually see them coming down in terms of the number of new cases. And so their epidemic has probably peaked. And it really began about maybe 3 weeks ago in South Korea. Italy, by contrast, is having a much more severe epidemic. So if you look at South Korea's statistics, they had about 7,800 people infected with 66 deaths. Italy has right now about 12,500 people infected and over 800 deaths. They've reached a point where their healthcare system is on the brink of collapse, and they've lost control of their epidemic. And what they didn't do was get in place measures to diagnose cases easily and identify those sick individuals and put in place the mitigation steps that would create the social distancing that would reduce transmission. And so I fear that we're a little late to this, and our opportunity to be South Korea and have a less severe course is closing. I don't think that we're going to have the kind of outcome Italy had, but we need to be very aggressive right now to try to avert that.
What does very aggressive right now mean? Give me like 3 bullet points. So what needs to happen, Dr. Gottlieb, today and in the days ahead?
We need to shut down economic activity in areas where we have known outbreaks and sustained community transmission. So you look at Northern California, Santa Clara, you look at Seattle, parts of New York City. This means closing businesses. It means mandating that people must telework. It means not allowing people to gather in places like, malls and churches and just shutting those things down. It means closing the school districts. But you also have to step in with assistance, and this is where Congress needs to come in. You need to offset the economic losses to the local communities, and you need to especially provide direct assistance to lower-income individuals who are going to be very adversely impacted. So it means increasing SNAP assistance for people who have challenges feeding their children and no longer will be able to send them to school and get food at school. It means direct cash assistance, literally cutting checks to lower-income individuals. It means increasing the Medicaid matches. It means allowing people to qualify for unemployment insurance without having to look for a job. Right now, you have to be actively looking for a job. You don't want people actively looking for a job in a region where there's a known outbreak of coronavirus. So we need to step in with that assistance to help support these measures. We're not going to do forced quarantines in this country. We're not going to do lockdowns. But if you slow economic activity in a region, effectively everyone's going to stay at home and watch a movie. And that's what you want right now. That's what you want in areas where there's spread.
You say in this thread that there's been a, quote, a void left by policymakers. Presumably you're talking about the federal government. Does it now have to go into the hands of the states, to the governor level of all this, to make the more dramatic and perhaps some would say radical changes that you say have to happen immediately?
Well, I'm talking about state governments, too. I mean, in this country, we leave a lot of discretion to local officials when it comes to matters of public health. There's a lot of good reasons why we do that. But in a setting of an epidemic like this, where you're asking local officials to basically sacrifice their local economy and hurt their residents for the national interest, that's a very tough decision. And that's why you're seeing a patchwork of responses where some governors have been very aggressive. Andrew Cuomo in New York has been very aggressive. And some governors have been slower to act and less aggressive. In Washington State, I think they've been a little slower to act and less aggressive. And we're going to continue to see that patchwork unless you do two things. One, you start jawboning a little bit, and this is a role for the federal government. Start, trying to really press mayors and governors to take a stronger set of consistent actions. You don't want to step in and federalize it, but you want to have a consistent approach. And two, provide assistance to take some of the sting out of those measures. We're going to end up spending a lot of money on coronavirus federally. We're either going to do it in the form of a bailout after the fact, some kind of stimulus to try to restart the economy, or we can do it up front to try to buy the kind of public health outcome we want. I would much rather spend the money up front to try to support the kinds of actions that's going to reduce death and disease than spend it after the fact, after we've had a very large epidemic.
Dr. Gottlieb, I appreciate your time. Thanks so much for joining us.
Thanks
informing our viewers of what they are facing perhaps in the weeks ahead. Let me take care of a couple things, too. Jonathan Krinsky, thank you for joining us. Tony Dwyer, I apologize. Just so many moving parts. We're going to talk to you tomorrow. We're also going to talk tomorrow to Carl Icahn at about 12:30. He is, if you want to call it, quadrupled down in Occidental Petroleum. We're going to talk to him about that. We'll obviously talk to him about the current market environment. That's 12:30 tomorrow with Carl Icahn. We look forward to that. It's been a while since we've heard from him. So we will do all of that tomorrow. Right now, we're joined on the phone by the tech investor Chamath Palihapitiya of Social Capital. He also is part owner of the Golden State Warriors. He sits on their board as well. Chamath, thank you for calling in.
How you doing, Scott?
I'm good. Thank you. Thank you for being here. Let me ask you first, as an investor, before we talk hoops, what are you telling as a venture capitalist your portfolio companies, and how are you as a tech investor thinking about all of this? Mark Cuban was on a little while ago, said he was actually buying some stocks. I'm curious as to what you're doing and what you're telling people.
Well, I think that there's two reactions that I have. I think when I look at what's going on in the world, what I would tell you is that the markets are in complete sort of turmoil and panic, and socially people really haven't had meaningful behavior change or reactions. And I think, unfortunately, I've been telling people that it needs to be the opposite, that, a little bit of social panic is actually a good thing right now, especially if it leads to the social distancing and the type of behavior change we need to try to decapitate the spread of the virus. Meanwhile, I think financial markets need to try to take every deep breath whenever it's possible to realize that these kinds of corrections are deep and they're severe, but they're always relatively short-dated in the fullness of time. But the opposite reactions are right now is sort of what sets us up for a potential perfect storm, which is really what's concerning. And so, on the public equity side, I actually haven't done anything and I really shouldn't even be saying this, but luckily, so far, the things that I own have kind of hung in there. Although for how much longer, I don't know, because I suspect that we're, not anywhere near the lows. But on the private side, I've been telling all of our CEOs that this is a very, very untested moment in our history. It's not like the great financial crisis. It's not like the dot-com bubble. It's kind of like both at the same time. It's the severity and the depth of the great financial crisis and the long refractory period of the dot-com bubble. So that means that you could be years without finding a real bid for your equity. And so cash and liquidity really are the most important things right now.
Those are pretty sobering thoughts. I mean, can you sort of put us on the ground in the valley? Santa Clara has been hit from this. Just sort of, what are they talking about there?
Well, here's the thing. Look, I think that there are, periods of time where there are errors of omission, and then there are periods of time where there are errors of commission. And I think as of yesterday, we are firmly in a moment where every day that we don't decisively act is an error of commission. And at the federal level, I think the president was actually right to sort of, block the borders. Unfortunately, he sort of arbitrarily picked Europe. And I think that doesn't make any sense, really, because you either block them all or you block none. And, all Europe has done is proven that, they're trying to create transparency through testing. Every other border, I think, are just, lagging behind in testing capability and an awareness of the actual virality of the disease. And so, to allow people in and out, it just doesn't do anything. So it's a symbolic gesture that I don't think stops anything in any meaningful way. So if the federal government right now is sort of in the land of commission, I think the responsibility will fall to governors, and really it'll fall to the local health departments. And this is where I see some really great things happening locally. San Mateo County, Santa Clara County, where we live, are responding decisively. They're responding quickly. They're doing the hard things. They're sacrificing their local economies in hope for this greater good to prevent the social spread of this novel coronavirus. And so schools have been dismissed. Folks are working from home as much as possible. The problem is now we need the federal government to step in and provide the social and safety infrastructure that all Americans deserve. They deserve them every day before today, but from today on out, they absolutely deserve it. The richest country in the world has no excuse for not stepping up and taking care of every single man, woman, and child in America.
You said earlier that we're nowhere near a bottom. Those were your words. When do you think we get there, and how are you going to know when we are there?
Well, bottoms are not created 18 days after something like this starts. So you can go back in time and look at every meaningful drawdown in the markets, but when you go tip to tail in a bear market in 16 or 17 days, and they are brought by things that start as an exogenous event, but then very quickly morph to a broad set of externalities to a large set of constituents. What we're dealing with now is a broad-based market decline, broad-based impacts to GDP. So, for example, if you just look at travel, the travel industry and all its related interconnected businesses, are almost $9 trillion of the world's economy. Now, if you think you see travel trade off by 50 to 60% for 2 quarters, that's 5% of the world's GDP that's going to go up in smoke. And so these knock-on effects, I think, are multi-month. They're probably multi-quarter. And again, I go back to how I started. In the absence of massive and decisive federal intervention that creates confidence in the markets, it has the potential to be multi-year. And this is where I hope, the rancor and the partisanship ends today and people really in the federal bureaucracy figure this out. But if they don't, then the drawdown I think tip to tail will be as bad as the great financial crisis, except unlike it, we're not going to see some clever, cute V-shaped recovery. We're going to see what we saw after the dot-com bubble burst, which is years of malaise.
I want to get some reaction to what you're saying here from our panel, because they're listening intently, and I can tell from their faces that they want to react to what you're saying, Ron, and you're the one I looked at here. That's a very sad and sobering view if it comes true.
Yeah, and listen, it's hard to disagree with the numbers with respect to the impact on global GDP. When you look at some of the airline traffic numbers coming out of Asia, you're seeing cancellations of up to 85% of flights. So this is profound. And when you start talking about travel restrictions in the United States, in Asia, in Europe, this really puts a freeze on the movement of people and potentially the movement of goods, because those people who are delivering goods will not be allowed off the boat, as we heard from the president last night. So the multi-year process, I think, depends on whether or not we, as was said, get a forceful response. And where Scott Gottlieb said, we shouldn't nationalize the response to this. After 9/11, we nationalized certain responses like TSA and things like that, where the government stepped in and provided both a psychological and a substantive safety net to the economy. In the absence of that, and I mean full-blown, as Chamath suggests as well, then yes, I think you could see a much longer holdover and not that V-type of bottom. We have not seen any concerted, coordinated action at home, globally, as Jim had suggested and as Joe suggested. In the absence of that, you get a much more prolonged market problem and an economic problem as well.
You see, here's what I think is, when I said there's no bazooka, there is no bazooka. The Fed may have monetary policy, but that bazooka has been used to cure tight credit conditions, which we're getting in, as I pointed out a few days ago, before everybody started talking about it. I've been the most bearish guy on this desk in this environment, not putting money to work, except today I shorted Under Armour, right? And I added to my shorts in the Qs and to SMH and to VOO. But here's the point. The bazooka doesn't exist because, as was just pointed out, this extends to the entire economy. It's not just the financial industry. It's not just the oil industry. It's every single business.
The one thing I'll say, though, is if Eric Rosengren, who suggested the Fed may buy different assets or may expand its asset purchases, that means corporate bonds, that means airlines, that means energy. They may redefine that intervention process.
Ron, but there's no intervention when people aren't leaving their house to go eat dinner, to go to work.
That's exactly right. Guys, you guys have to keep something in mind. Look, we've seen three important examples, and I think we would be foolish to ignore them. Example number one, China acted within weeks in a completely repressive and authoritarian way, but it worked.
Do you believe the numbers?
So hold on 1 second. It doesn't matter whether you believe the numbers or not. The point is that I think that directionally they have gotten this thing under control. Example number two, South Korea acted in a very different way, but with broad-based testing. It seems to have worked. Number three, Italy reacted by a broad-based, federally instituted, top-down shutdown of everything. We don't know yet whether that works. We have done none of those three things. We don't have the capacity for number one, politically speaking, or culturally speaking. We haven't been able to do number two, and we have no idea whether number three can even be effective at this point in the game. So when you put those three things together, the only thing we can now start to do, in my opinion, is really start to map out the level of stimulus that the federal government needs to inject in the system. It will be TARP level. It'll probably be more than that. For example, you have $1.6 trillion of debt that's junk or just above junk just in natural resource companies in the United States, which also happen to be the largest employer in the United States. So now you could have both, an employment shock where hundreds of thousands of good American, hardworking citizens are furloughed or fired, at the same time as these companies become insolvent and somebody needs to step in to buy upwards of $1 trillion of debt. That's just in one industry.
Chamath, I did want to talk to you about the NBA, but I feel like we should do that another day. I think we've gotten our arms around what the professional sports leagues are trying to do to get their their arms around it. We're thinking of everybody in those industries and the fallout, not only from the team level, but to the vendors, the folks who work in the arenas who have already been affected. Let's do that another time. I hope that we can talk to you again. I do appreciate you coming to the phone.
Thanks, Scott.
All right. That's Chamath Palihapitiya of Social Capital joining us there on the phone. I mean, you start talking about, I know we keep hearing a lot of this is not the financial crisis, this is not the financial crisis. I mean, we get that in the sense that it's not the banks that are the ones at the most risk. But that doesn't mean, Chamath is saying, I think, that you can't have a financial crisis-like feel and reaction in both the economy and the stock market. So maybe we need to pay more attention to that perspective than shooting down the idea that this is another financial crisis. This is a crisis. And it's going to have a dramatic impact on a lot of different things.
Where this is unique and it's very difficult to model any prior circumstance, and where I don't think you could compare this to 2000, because remember, you had 9/11 after the dot-com bubble burst. So it was
the corporate crisis.
It was a double shock. But I think you're going to the right place with this in the sense of, I think we have to acknowledge that economic activity has frozen in spots of this country. In particular, it's happening here in New York City. And I think it's fair that we need to just acknowledge that and go from there. We need, when I say coordination, Stephen, and let's forget about whether it's a bazooka. I think more than anything else, we need a bullhorn. We need a bullhorn to understand that we're all for one and one for all. And we need the coordination both from a medical capacity, from a fiscally stimulative capacity, to encouraging investment in the stock market. The stock market's down 40%. How about encouraging investment? How about taking 401k limits and expanding those? There are so many things that we could do. There are so many things that we could do right now and utilize this as somewhat of an opportunity, in a sense, to improve
no doubt, but
the context. Let me finish, Steve. The context of the way we do things. But I think the first thing we need to do is exactly what you're talking about, Scott. Understand, okay, this isn't a financial crisis. This is a biological crisis. We've never modeled a biological crisis before. And what the biological crisis has done, in 18 trading days, it's frozen major economies in this country.
And Joe, we haven't attacked the biological crisis. Everything you're saying is valid. Everything we're all saying is valid, but we haven't done the testing.
That's why I understand. That's why we're down as much.
I'm saying I don't think we're going anywhere until we get a real handle on these numbers. I don't know what the number of cases in the U.S. are. Is it 1,200? That's a ridiculous number. It has no meaning, and the market can't process it. We've got to get the testing.
Needs, I think, Ron, you tell me what you think. It needs to know and have some level of confidence. The health and human side is a huge part of it. That's for the greater
market's bouncing nicely, by the way.
The greater public. I'm just reading the headline at the bottom of your screen. I'll finish my thought in a second.
Okay,
New York
so
Fed says it will conduct new purchases across a range of
that probably means assets.
Purchases.
Yeah, that probably means a range of assets.
Three-month repos, $500 billion.
Is that what it is?
Yes.
My point is that the market, from just a market standpoint, needs to first have confidence and know that this economic crisis, and that's what this is going to be dealt with. Right now, it doesn't have the confidence that it's going to happen. It hasn't seen enough result at this point to believe that what Jim Cramer says and what Chamath has suggested and what all of you and everybody else are saying, it needs to see and feel like something of great magnitude is going to come. That's only part of the story. Right. And then it's the health side, too.
Yeah, when you go back to prior crises, just to isolate the financial and economic side, the federal government mobilized, had a unified voice, reached out to the business community. Folks like Warren Buffett, Bob Rubin, and others, Alan Greenspan, went on 60 Minutes during one crisis and started talking about, where we are, what the resilience of the U.S. economy is. The Fed came out, did its piece, and did it in size. In all cases of these prior crises, whether it was 87, 97, 98, 2000, 2008, you saw unified responses from the federal government, local governments, business community in order to turn the ship around. We have not seen either the leadership nor the strategy that's required to at least stem the slide.
There are people who are going to agree with you. Some may not, but you have to believe, my God, we hope, that that's going to happen.
You have
at some point.
And the example is there. When I think about 2008, I think about Sunday night. I think it was March 15th.
Hold your thought real quick. Steve Leisman's on the line about this move from the New York Fed. Steve, what can you tell us? The market is trying to bounce a little bit, at least a little bit, on these headlines.
Scott, this is a massive move by the Fed coming into the market in a very big way. I don't remember anything like this, approaching this in terms of putting $500 billion in a 3-month repo operation. And then they're going to come back tomorrow with looks like another $500 billion. I believe that's $1 trillion. I believe that's in addition to what they're already doing. They are, flooding the zone is understating what it looks like they're doing right here. And I'll quote from the release, Scott, they're saying, these changes are being made to address highly unusual disruptions in Treasury financing markets associated with the coronavirus outbreak. And we had heard earlier today that there were pretty bad disruptions in the Treasury markets, Scott. We've been talking about that all week. We heard it worsen today. I was talking to several senior officials at investment banks, and they were saying the Federal Reserve needed to come in some way. I don't know if this will be considered sufficient, Scott, but I will tell you, everybody is waiting in just about 2 minutes for that 30-year auction to see how it goes. It's expected to go well. We'll see if it tails off. We'll see if it's all taken down. But that's the next big test with the Federal Reserve coming in a massive way into the repo market here.
Can we call this, Steve, is it fair to call this the first bazooka in all of this has been shot by the Fed? I mean, there are some who are saying that the Treasury needs to launch one too, and that the federal government itself needs to come in with some stimulus. But would you characterize this as that?
I think bazooka understates it. I have to go back and look at my history of other actions by the Federal Reserve, but this looks 4 or 5 times bigger than I've seen in the past. Of course, the Treasury market is 3 times larger than it was back in 2008. So there's more paper out there that the Fed has to offset. But I don't know, when they're talking about major artillery here, I think bazooka might be an understatement. Or if my math is right here, Scott, $1 trillion of money into the overnight market here on in 2 separate 3-month operations, 500 and 500.
Wow, Steve, big news. Thank you for coming to the phone. Stocks are certainly attempting to rally off of it. They're still down sharply, but...
Scott,
yeah, go ahead, Steve.
Here. One other line I just picked up, 3-month and 1-month repos will be, for $500 billion, will be offered on a weekly basis for the remainder of the monthly schedule. And I got to start doing the math as to how much they're putting in, but they're putting a lot in, it looks like, right now.
Steve, thank you. I know we'll talk to you again in a few moments. Ron, your reaction to this?
Yeah, I think Steve's right. Bazooka's probably understating it. Now, I suspect if you go back to 87, when they promised to provide infinite amounts of liquidity, that was something maybe similar to this. But again, different set of circumstances. We probably still need more from an economic perspective, but this is an opening salvo, I think, from the Fed that may lead us towards some type of resolution.
The Fed just can't risk a credit crisis of great magnitude. That's the bottom line.
Right. So I just covered some of my index shorts while Steve was talking, while you were talking.
Just now.
Yeah, just now. I'll put them out again. I also bought a little Boeing just to trade it because it will bounce on this. I also think Boeing is a great acquisition candidate for Warren Buffett. He's got $125 billion in cash. He owns Precision Castparts. He owns Burlington Northern. He can come in with a market cap of about $90 billion. Buy it. From an antitrust standpoint, I don't know if it's accurate that he can do it, but
more likely to do the preferreds that he did with Goldman and GE.
Except he wants to buy a major asset.
Just so easier to do that.
I think a lot of us are kind of wondering what Buffett and company are thinking and maybe doing in the hours and days ahead.
I'm sure whatever it is, it's the right thing. If I could finish my thought from before, it was that my memory of 2008 and 2009 was, I believe it was March 15th of 2009, and it was Ben Bernanke going on 60 Minutes and communicating the type of leadership and comfort and confidence to both the consumer and to corporate America that is exactly what's needed right now. And I'm hopeful that we're going to get that.
But the difference is, just one thing, the difference is that he had credibility. This Fed has no credibility, nor does the president. So, for example, the market's only up 5% since he took office. It's not a big. It's got to go to 50,000. We could down.
This is necessary.
I don't want to do that now because we don't have the time to do it. Last quick thought, please.
It's necessary, but it's not sufficient. To get sufficiency, you have to get testing. The market doesn't know how long this downturn lasts until we get numbers on the virus.
And we'll see what may happen throughout the rest of the day. Let me remind you of Jim Cramer's big interview tonight. He's going to sit down with Senator Elizabeth Warren. Do not miss that. That's at 6 p.m. tonight on CNBC. That does it for us. Let me hand it off to Kelly and the Exchange. Kelly, thank you for letting us bleed into your show a bit. We do appreciate the time as you pick up this story.
Scott, absolutely. It's great stuff. We really appreciate it. Some fascinating comments. You heard Steve Weiss there speculating about Warren Buffett and Boeing. I was looking at Caterpillar's market cap. It's only $50 billion today. Welcome to the exchange, everybody. We are covering this liquidity story big time for you this afternoon. There's a grab for cash by companies to get through coronavirus. And the big question is whether financial markets have enough of it. Now you've seen this major move by the Fed. Bazooka was an understatement, as you heard Steve and Ron just discussing there. We want to get some immediate reaction here. Bob Bassani's down at the New York Stock Exchange. Bob.
And, of course, the question, and we're just looking at each other down here on the floor, is this the opening salvo, as I said before, from the Federal Reserve? But we'll take a look at the S&P 500, because that's what the traders watch. 2950 is where we were, about 1253 or 1254. We are, as you can see here right now, 2616. So we have moved 68 points in the S&P 500. That's rather remarkable. That's more than 700 points in the Dow Jones Industrial Average just in the last 7 or 8 minutes. I don't know if you can put up some stocks that have been down that suddenly went positive. Johnson & Johnson, for example, was down the mid-single digits at 1250. There it is, just went positive. United Technology was down mid-single digits. It went positive just a moment ago. I saw something go by on the tape there. So it's really been quite a remarkable turnaround in the last few minutes. But a lot of damage has been done. I just want to show you the sectors here. Effectively, this is a takedown I talk about every day, where almost every sector was down 8% towards the lows of the day. So it doesn't matter whether it was healthcare and consumer staples or tech or industrials. Everything was down 8%. Now look at the changes here. Yes, everything is still down 3 or 4%, but that's almost a 5% move that we've seen. This has happened in the last 10 minutes, the change that we've seen. A lot of people are asking me about bottoms. I spoke with Art Cashin this morning, who's recuperating, sends his best wishes. He is looking at his number, 2351. That was the December 24th low on the S&P 500. We are well off of that, but we were approaching that earlier in the day. And interestingly, that would be a 30% decline, which would be a typical recessionary decline in the S&P 500. 30% is fairly typical for most recessions. The Great Recession was 50%. That's a real outlier. Finally, I want to show you some emerging markets, ETFs. You think it's ugly here? We've seen almost 20% decline in some of these other ones. Brazil, emerging markets, MSCI, Mexico, Africa. These were all down much more than this just 15 minutes ago. Finally, I know there was concerns about what's going on here and the stimulus program. They were not impressed with Christine Lagarde this morning at all. The European stocks closed right on the low. She talked about bond purchases, cheap loans, but no rate cuts there. Guys, back to you.
Okay, Bob, thank you so much. And let's again look at the Dow Jones Industrial Average, only down 839 points right now. At the lows today, we were down 2,220 points. So this is a huge turnaround. It comes after the New York Fed said it is injecting tons of liquidity into the market, and that came just minutes before the 30-year bond auction that just went off. Rick Santelli is out at the CME. Rick, how's it looking?
You know, I will give this auction as a D. D as in dog. But that certainly doesn't give you all the information on this auction. Let's go through it. 16 billion 30-year bonds, the longest maturity. The yield, 1.32. Where was the when issued market? 127 plus, 128, 128 plus. It was right in that area. So we tailed about 4 basis points. That's why it received the D. But in a Dutch auction with this kind of volatility, it really isn't surprising. If you look at the rest of the metrics, it looks pretty good. If you look at the bid to cover, 2.36 is above average, 2.3 is 10 auction average. 69.5 on indirects is the best since January of 18. Now, the 8.9 on directs, that isn't a good number. That's basically almost half of what the 10 auction average is. But think about the big institutions that aren't in accumulation mode, they're in liquidation mode. So that category you would think would be lost anyway. So all things considered, the dealers take about 21.6% of the auction. I was shocked. I thought they'd end up taking more. All things considered, it had a pricing problem. That's been the talk of the day. Wide bid-offer spreads. Why should it be any different on a 30-year auction? But the other metrics were pretty good. And we've gotten some buoyancy here as equities, of course, have moved off their lows. None of this is easy. And I'd be lying if I told you these markets are operating perfectly normally. But nobody would expect them to. The real issue is that everything has moved and we have a major repricing all on quicksand. So far, at least in my opinion, seen a lot of these over the years. It's nothing to brag about, but it's as orderly as I would have expected. Kelly, back to you.
Okay, Rick, stick around if you would. I want to bring in Steve Leisman by phone as well. Steve, I don't yet see the full announcement from the New York Fed, but it seems like there are several pieces of it. There's the $500 billion of liquidity. There's also expanded asset purchases. Are those one and the same? Can you give us all the details as far as you've learned on what they're doing?
There's two separate things going on here. One is $60 billion. Let me find it here. The announcement is on the website of the New York Fed. So it's $60 billion reserve management purchases for the monthly period beginning in March. That's going to be spread across a whole bunch of spectrums, a whole bunch of securities there. Put that to the side. And I'm sorry to tell you, Kelly, I think you had it only half right, even though I still can't actually believe it's this much. But they're going to offer, and I'm reading directly from the release, the desk will offer $500 billion in a 3-month repo operation. It looks like that's today at 1:30. And then it says tomorrow the desk will offer $500 billion in a 3-month repo operation, and that's $1.5 trillion. I hate doing the math on TV here, but they just laid this on us, Kelly. It looks like it's $1.5 trillion of repo, from what I can tell. And then keep going here. It looks like an enormous amount of money, and this comes after senior executives I spoke to this morning, Kelly, were expressing deep concern about the operation of the Treasury market, about spreads, about the differences between the futures and the cash market, and a lot of concern about dislocation. And I was able to confirm that the New York Fed was aware of this. They would not talk about it, but I was able to confirm they were aware of this. And so this must be in response to what we heard from senior executives in the bond market about the way things were trading, about possible and wide dislocations. I've heard some very ugly terms used about how the
by quite a bit, having them, in fact, the S&P down now just 4%, the NASDAQ down 4.3%, the Dow down 4.1%. Trying to get a sense of what exactly will happen with all of these repo operations, and we will get you more details as we get them.
Anyone can ride a car that's meant for you. Good night.
Ride the change with Ola. Download and sign up now. Enjoy no surge pricing until the 12th of April.
I'm sorry to do this. It's 2 3-month operations at 500.
Fall considerably more than they had earlier, which is interesting.
Okay.
That's $1.5 trillion, I think.
That's huge.
If I'm not mistaken, Kelly.
Steve, stay right there. We're going to talk more about this. The market way off its and Chief Investment Officer of Wealth and Investment Management of Wells Fargo Investment Institute. Peter Bookvar is Chief Investment Officer of Bleakley Advisory Group and a CNBC contributor. Rick Santelli is still in the discussion as well. Peter, let me come to you first. What are your thoughts about this extraordinary move?
So I've been hearing the same stories that Steve heard, and that there's essentially has been dysfunction within a lot of markets. Now, obviously, the Fed's trying to address the Treasury market, but this is sort of like the legacy of the Volcker rule, where dealer inventories are just not there. The market makers that we used to see are just not there. So you're seeing these liquidity gaps that everything is falling through,
Rick
and the Fed is trying to fit that
vehemently
in.
shaking his head in agreement there. So you're saying this is a problem that effectively goes back a decade but became acute this week. Ironically, yields are declining, right? So in a way, you would expect a lot of times when there's no liquidity and yields are shooting up. That's not exactly what's happening here. So why the panic about what's going on in the Treasury market, and how is that connected, Peter, to the rest of the financial markets?
Well, you really can't get more liquid than a Treasury market. And when you start to see bid and offers start to separate, it tells you that there's real fear that no one is willing to step up to be that buyer to the seller, or the seller to that buyer.
Of even
and that tells you there's
stuff in the market.
Exactly.
Right?
So that tells you there is dysfunction, there's panic, there's not enough capital to back these bids and offers. And again, it's legacy Volcker rule.
I don't want to be too picky on these minute-to-minute moves, but one more thing before I move on, Peter, is we're now down 1,300 points still. So there was definitely some initial relief here, but is this enough relief?
This is just treating a symptom. The relief is when we get millions of tests over the next couple of weeks. We separate the healthy from the sick, and we continue this shutdown while it's damaging to the economy. At least gets us to a safer place. A lot of people that then won't get infected.
Okay, Daryl, let me bring you in on that. And, as these markets continue to gyrate here, will this big move by the Fed, you think, ultimately help to calm things down, especially as we head into the weekend, or not? Is it all going to come back to coronavirus and the public wanting more assurances there?
Well, I think you're right, Kelly. You just hit on this. So this is infusing liquidity into the market in a huge amount. But it's not necessarily targeted stimulus that the markets have wanted, which is why I think you're seeing a little backup. Peter's points are spot on. Yesterday, we saw a very unusual move in rates going higher, credit spreads widening, the U.S. dollar strengthening, and equity selling off. I've only ever seen that happen 2 times, and it tells you there was liquidity issues with the U.S. Treasury market, and therefore the Fed comes to the rescue. The only other point I'd make, too, here is, remember, the issuance market is relatively closed, if not outright closed at this point. So companies started to draw down those big lines of credits out of an abundance of caution because they're not able to access the bond market right now. They're not able to sell bonds in this type of environment or refinance bonds. And so they needed to capture that liquidity while it was available.
Barry, let me bring you in here because, you take a much longer-term view of these things. I sort of think of you as Buffett-esque in that regard. Would you expect this to be the kind of market that Warren Buffett, if we're looking for votes of confidence, we've just got a liquidity vote of confidence from the Fed. We, frankly, kind of can't order up a vote of confidence in terms of treating coronavirus. What do you think that, if anything, if you were, Berkshire, if you're Buffett, are you looking here? Are you, like I said, Caterpillar's market cap is $50 billion. I think Boeing's down to $90 billion. There's been massive dislocations here.
Yeah, I see a big donut, and it makes me hungry right now. On one side of the donut, things were going along great. Now we're in this hole. We don't know how big this hole is going to be, but things are going to be great on the other side because the economy is going to pick right up in the sense that there's going to be pent-up demand. So what we have right now is something we don't know, how much earnings will fall, how much the economy will slow down. But I see a big banquet table, and they're starting to put these things I love to eat on the banquet table, and I would be starting to look at what I wanted to buy more than what I wanted to sell. Yes, there are some things to sell right now, but I'd be looking at that second move, which is what would I want to buy? What will do well after this passes, as the other guest mentioned?
And let me ask, as Rick, Steve, go ahead, jump in there. Steve Leisman.
Was just going to say, I don't think people should get the wrong impression about this injection of liquidity by the Fed. It's not going to solve the coronavirus. It's not going to solve the economic fallout with the coronavirus. This money looks aimed directly at a specific issue which is out there, which is the difficulty in trading, the buying and selling of Treasury securities, and the effort to make it so that those markets operate efficiently and are able and operate orderly. I don't think this solves any of the problems that stocks can rally or not, but to the extent that there's panic and concern about how the Treasury market is trading, we'll have to wait to see if this amount of money is sufficient to solve that problem. But it's specifically aimed at one thing. So new viewers who are coming in and aren't used to this sort of thing, they need to understand this is a very technical operation, flooding of the zones, but there's enough money around for buyers and sellers of big institutions to buy and sell treasuries to make sure it functions orderly.
Yeah.
It doesn't solve any other problem.
Let me bring Rick in. Rick, it's been about 20 minutes since this announcement, and like I said, a little more relief in the immediate aftermath perhaps than we're seeing now, but are there signs in the Treasury market Is it too soon to tell about whether this is kind of helping to grease the wheels, so to speak?
It's kind of hard to tell because, in the grand scheme of things, we're talking QE, but really what we're talking about is what the Fed's doing is make sure the gears of short term, kind of like the issues of commercial paper back in the crisis. It really is more about these arrangements that have claims on Treasury securities that up until about 36 hours ago, everybody wanted. Now there's a liquidation side to this, whether it's munis, some of the highest quality fixed income products. And I think the Fed's very smart. I never have issues with these facilities. They do a good job and we need to address liquidity. Where my issue is trying to do more. There's no capitulation this time like there was in 07 and 08 in various sectors, whether it was the mortgage sector or when Lehman went under. See, the health side of this doesn't give us that luxury. So really what I see is markets trying to tread water in the twilight zone of pricing, and the Fed's trying to make that ordeal last a little longer. But until we get more numbers on Corona, whatever that is, you can blame it on politicians, on test kits, on whatever you want. But this is very hard for markets to It's like trying to change 4 tires on a car going 80 miles an hour.
And the Dow's down about 1,400 points still as we discuss this. That's a 6% drop. Peter, one thing is Barry mentioned this idea of looking towards the other side when we come through the coronavirus. And it's different from the financial crisis where that had this long financial repression aftermath. You would hope in this event, like you said, there's pent-up demand. People want to get back out there. It's kind of like being stuck home with 2 kids for 2 years, which I know a little bit about. So here's my point. Inflation. Right now you have Treasury yields at historic lows, and the Fed is probably in some ways going to end up pushing them negative. They're meeting next week, April, so forth. What happens coming out the other side of this if there's any hint of supply shortages creating inflationary pressures?
Well, I think you're going to see that demand rush for everything, that the pent-up demand is going to be enormous, and the supply side's not going to be able to immediately step up to that. The production side, the shipping side, good luck trying to get a ship to deliver the product that you need. So we are going to see, I believe, a supply inflationary price shock that is to follow. Now, it'll probably be temporary until things sort of readjust, but I think that is to follow. The question is, do treasuries respond to that by selling off and seeing higher yield, or do they look past it thinking that maybe it's just temporary?
Sure, and Daryl and Barry, I want to give you guys a final word here. Barry, I know that there are individual names you think people should buy, but broadly speaking, would you call this a market panic? Do we use the word crash, Barry? You've seen a lot of these cycles. What would you liken this to?
Yeah, it's like 1987. I remember 20% in one day, so this isn't that unusual. It was about 40% in 40 days. It could be that short of a decline. It would not be surprising to us that we would see some more down. I would look at, in terms of investing, things that are high yield type of bonds or high yield, highly levered companies. I would probably stay away from those, and those that are definitely impacted by the coronavirus. The travel industry, try to stay away from that. But there's things that are just dropping down, bargains, and I think that there's some good opportunities to start nibbling. Don't go all in, start nibbling.
Daryl, last word to you.
Yeah, Kelly, so what I would say is watch for true capitulation, which may be here. Part of the reason for that thought is you're seeing risk-off assets, defensive assets, actually sell off now. Utilities and REITs, which were plumbing new highs literally days ago, are now down 18 to 20%. Gold is selling off. U.S. Treasuries have come on the 10-year from 31 basis points back up to 75 basis points. Those are showing you that those risk-off assets are getting sold in this environment, which is usually and historically a good sign that capitulation is near.
Okay. We thank you, Barry, Daryl, Rick Santelli, Steve Leisman as well. We'll probably hear from you guys again throughout the show. Peter Bookvar is going to stay with me because we want to talk a little bit more about the banks, which are seeing a small comeback here on the back of the Fed news. It was just about half an hour ago. Again, the Federal Reserve stepping up with $1.5 trillion of liquidity and $60 billion of what we can effectively call quantitative easing. Let's bring in Gerard Cassidy. He's Managing Director and Banking Analyst at RBC Capital Markets. So glad you're here.
Thank you.
What are the mechanics of this? Why would the Fed do this? What are they trying to accomplish, and how do you think it'll play out?
I think what you're seeing is that the Fed has to provide liquidity to make sure that the markets function efficiently and effectively. They've done this in the past, and I think you'll see them continue to be interactive with the markets to make sure that they don't freeze up.
Because it's the banks who are among those that use this overnight, these repurchase operations. Is that right?
Well, they're part of the process. The money market mutual funds are very big in it as well. So it's the entire financial system that are interrelated, and they have to make sure that liquidity doesn't dry up.
And why would they need to go to the Fed for this liquidity? The fact that they are offering it and that's where these participants go, where would they typically get it?
Well, typically when markets are this volatile, the Federal Reserve will always come in, and that's what they were created for, the lender of last resort. So I think the Fed is doing what it's supposed to do, and if they could calm down the markets, that obviously will help everybody.
One point that Peter made a little while ago is that you go back to the financial crisis sort of hallmark legislation, the Volcker Rule, which was meant to make sure that banks weren't trading with client money, so to speak. But the effect of that meant that banks weren't doing a lot of trading, period, that they had traditionally done, for example, in the bond market. All of the stuff that we've seen happening in the Treasury market this week, is that telling us that perhaps the cure was worse than the disease, or how would you kind of interpret that?
It's a little too early to tell. We'll do the post-op, hopefully in 3 or 4 weeks from now. But I would say this. The Federal Reserve knows that if it needs to do anything, it will do it. Meaning, during the crisis, it broke the rules. It did things that nobody expected it to do. And I would say that if they think they need the Volcker Rule suspended, they'll suspend it. So what I would say is they will pull out the big guns to make sure that this does not lead to some sort of collapse like we had in 08-09.
Right, although, Peter, those desks don't exist anymore to some extent. They're gone.
They're not going to get revitalized.
Those participants are gone.
Right, but this is the side effect.
How do you expect, so the banking industry obviously at the heart of, if we look at the headlines the last couple of days, it's companies like United Airlines and the cruise lines tapping their credit lines. Is that why what you think the Fed's ultimately trying to do here is, yes, help trading market liquidity, but also make sure that liquidity in the kind of system in general, we should say, is available? In other words, how would this go from helping the banks per se to helping oil and gas, travel industry and so forth, or will it?
Well, it's certainly not going to help the fundamentals. I think it tries to help confidence in that people want to believe that the system is not going to all of a sudden, collapse under its own weight. I think in terms of the companies that are tapping these credit lines, it'll be specifically those companies that may have maturities coming up this year or next, those that have immediate working capital needs, but there's still a lot of other cash-rich companies that are not going to. I mean, I'm hearing so far that while the headlines are the Boeing and some others that are tapping, most companies are not. So we'll have to see how this plays out, but that's what banks are there for. They're well capitalized and they're prepared for things like this.
I think you said it perfectly. The banks are very well capitalized, and we're seeing a re-intermediation back into the banks. So the banks have lost out to the shadow banking industry for 30 years. So now they have the capital, they have the liquidity, and these lines are set up for this very reason. So sure enough, these companies have this access, which is very good.
Although the market's not getting them much of a vote of confidence.
Correct.
Why, for example, is a name like Bank of America one of the worst performers? We're used to in the past seeing Citigroup often the one that's really taken to the woodshed. Is that because Bank of America represents the broad consumer economy? Did it have exposure to some of the weaker parts of the U.S.?
I think it's more just memory from what happened in 08-09, and unfortunately Bank of America was one of the troubled banks along with Citigroup. So I think what's going to happen is the banks can demonstrate, which we think they will, that they will get through this correction or this downturn very efficiently and maybe even profitably, that they will rebound and people will reassess that the banks do have the strength and the liquidity, and we shouldn't treat them like we did in 08-09.
Yeah, and so if we take a step back, then there's the kind of immediate overnight or term liquidity, let's say, from the Fed. There's also the $60 billion of purchases. And Peter, this takes us back to the crisis-era playbook, and it's actually coming before they have even cut rates all the way to zero. What is in the toolkit now? What does this reveal about how the Fed might be thinking about how to treat this continued market sell-off?
Well, with respect to their meeting next week, I think what we're seeing is it's not the cost of money that is the issue here. It's the flow of liquidity in different pockets to those that need it from those that can provide it. And shifting the cost of money from 1% of the Fed funds or 50 basis points or 75, that doesn't really matter. I think the Fed needs to shift to getting the money to those that need it, lubricate the liquidity in terms of the bid and the offer of these markets, and try to make sure that we can get to, let's just call it May or June, when this virus hopefully calms down. It's all about buying time right now.
Yeah.
It's buying time and to calm people down, to get us to springtime where we hope that this starts to calm down overall with respect to the virus.
All right. Dow had trimmed its losses to as much as down 750. We're now twice that much down, about 1,500 points. Thank you both, Gerard Cassidy, Peter Bookvar. Greatly appreciate it. We have some breaking news out of Washington where Senate Majority Leader Mitch McConnell tweeting just now, notwithstanding the scheduled state work period, the Senate will be in session next week. He says, I am glad talks are ongoing between the administration and Speaker Pelosi. McConnell adds, I hope Congress can pass bipartisan legislation to continue combating the coronavirus and keep our economy strong. Let's stick with Washington for a moment. Joining me now is Fred Kemp. He is CEO and president of the Atlantic Council. Fred, first of all, do you see a deal quickly emerging here despite all of the rancor of the last couple of days?
Kelly, I actually do. That was a great conversation, and thanks for having me on. You do provide light instead of heat at these times, and so it's terrific to come on. I do think they'll reach a deal because they have to reach a deal, and that really gets also to last night's address at the Oval Office, where Europe gets into the crosshairs of the president. We know that we need Europe at times of crisis. In October 2009, global financial crisis. Don't forget the G20 meeting where the U.S., UK, other European allies came together, and they stopped a hemorrhage that really could have led to a complete global financial meltdown. I was in Europe on 9/11. I was in the Eurostar under the tunnel from London to Brussels during 9/11. And at that time, NATO triggered Article 5, its collective defense mechanism, for the first time in history. It was essentially Europeans saying, we're going to come together to come to the defense of the United States if it needs it. That's the spirit of leadership we need right now. This is a global crisis. World democracies have to come together, and we're going to need the Europeans to address the financial aspects of this. So it's not the right time to put them up as the problem when they're part of the solution.
Fred, stay right there. Let me bring Elon Moy in. She is on Capitol Hill for us, also continuing to report on what stimulus package may be shaping up here. Elon, what can you tell us?
Well, right now it looks like the Senate just merely needs more time to try to assess what will come over from the House. I was speaking to a couple of senators as they went into the lunch where they discussed the decision to stay in session next week in order to keep debating this. I spoke to one senator, Cory Gardner, a member of Republican leadership, who said that he actually supports several parts of the House bill, but just needs more time to work through it, both with other lawmakers in the Senate as well as with the House. But the dilemma here for senators is that even as they decide to stay in session and continue these negotiations, there are a growing number who are having to either self-quarantine or have closed their offices due to the coronavirus. Senator Rick Scott of Florida is the latest to announce that he's going to be self-quarantining, was supposed to have a press conference, abruptly called it off when it was determined that he had come into contact with someone who has now been tested positive for the coronavirus. So these negotiations are certainly fluid. This is a sign that they do want to keep working, but I think everyone was surprised by the amount of pushback from Republicans to a bill that Democrats had hoped would sail through the House and perhaps even receive bipartisan support in the Senate.
Elon, stay right there. I'd like to make this a little bit more of a conversation with Fred. You know, Fred, obviously, I don't like when people blame the political process and say we can't have the partisan wrangling. Look, these people represent passionate points of view among their constituents, and there's a strong difference of opinion about the best ways to solve this crisis. Is there common ground? What common ground do you see that could shape up quickly here to get something of almost $1 trillion in size passed?
Well, I think the common ground's going to come when there's more of a realization of how much community spread there has been. We've got about 5,000 tests out there. The South Koreans have done 100,000 tests. The British have done 25,000 tests. So it looks like we don't have as much spread as different parts in Europe, but I think we are going to have it. And I think the more that it gets into the system, that it's not a question of whether or not this is happening. It's really a question of how far is it going to go. And I think as soon as that becomes clearer and clearer, you're going to have a lot less bipartisan wrangling and a lot more coming to an agreement. And I think the president has to lead on this. He has to say, look, and not only do we have to act internationally in unison, we also have to act together in unison, and he has to help the Republicans find their way to this agreement.
Yeah, Ilana, is there any support, as you can tell, for moving forward with something like a coronavirus czar, putting Dr. Anthony Fauci in that position, having a kind of a trusted, impartial person to become the voice of authority on this and let the rest of the country know how they should respond to outbreaks, figure out, literally spend 24 hours in a closed room and say, how is the Senate going to meet? How is the House going to meet? We can't afford not to have these discussions underway because of coronavirus.
Not in this particular bill, Kelly, but I will say that both Republicans and Democrats have acknowledged that this is not a perfect bill. There's not everything that either side wants in it, certainly not as much for Republicans as they would hope, but that they will have to take several bites of the apple. So right now what they're focused on is perhaps using the framework of the House bill, which does not include a coronavirus czar, as a starting point, try to get this passed, and then perhaps come back with something else. One of the sticking points in the bill right now is how to structure paid sick leave. So everyone agrees we should have sick leave for people who have to stay home because they've been infected or have somehow been having to quarantine because of the outbreak. But do you do that through the Social Security Administration? Do you do that through some other separate structure? How long should the sick leave last? How much should it be? These are the details that are now bogging down the discussion, and we'll see if they can get them resolved.
Yeah, I want him to take more of the Mark Cuban approach. He says, I'm going to take care of the people who work here. We'll figure out the details later, but I'm going to take care of it. Thank you both. Elon Moy, Fred Kemp, appreciate it this afternoon. Want to move on and talk about the airlines. They are getting crushed after the president's unprecedented European travel ban announcement. Southwest is down about 12% today. United and Delta, which would be more directly affected, are both down about 15%. And EU leaders are slamming the ban, saying the president acted unilaterally and without their consultation. The U.S. Travel Association also speaking out against it, saying in a statement, quote, temporarily shutting off travel from Europe is going to exacerbate the already heavy impact of coronavirus on the travel industry and the 15.7 million Americans whose jobs depend on it. My next guest says the outbreak could serve as a liquidity stress test for the airlines, and it seems as though we're experiencing that now. Brandon Oglinski rejoins me. He's an airline analyst at Barclays. Brandon, if this is a liquidity stress test, it's not a big vote of confidence by the market.
Yeah, look, we and Kelly, by the way, thanks for having us on. I mean, there's trying to put some stability in the markets here. But for airlines right now, and just given how much they're trading down, people are really worried about liquidity. No one knows how bad travel is going to get. We just heard this week that bookings are down 25 to 30% on a gross basis. That's from United and Delta. But on a net basis, that's net of refunds. They're actually down about 75% in the U.S. and they were down 100% in the Pacific and the Atlantic. So at this point, we're really stressing our models here. We took revenue down 80% in 2Q. We assume that all the advanced ticket purchases actually go away, so they have to fund working capital. What we find is that, American probably needs another $2 to $3 billion of capital. We think Delta needs about $2 billion. United did raise $2 billion earlier this week. I suspect we're going to see all the big carriers, especially those with more corporate exposed bookings, needing to raise capital probably in the next few days, actually.
Sure, and the $2 to $3 billion you described doesn't sound like it's that much of an amount given the numbers we're throwing around in general for coronavirus. Do the other airlines?
Well, I mean, if you look at Delta, they have an investment-grade balance sheet. I think all the major carriers have a revolver of some sort that, they can obviously draw down. That is included in their current liquidity picture. It's important to note, United came out on, I think, Monday or Tuesday. Their next CEO, Scott Kirby, said, look, we've modeled a pretty draconian scenario with revenue down 60 to 70% this quarter, tapering off to about down 30% in the fourth quarter, which would be really unprecedented. Keep in mind, September 11th, revenue went down 20% for the industry. So this would be a really big test. But they said even in that scenario with the capital they've raised, they believe they can be cash positive by $3 billion throughout the whole course of that type of contraction. So I think it's really prudent for the boards and the management teams right now to be looking at cash. What sources of capital do we have? And unfortunately, for American, they've obviously pursued a more aggressive strategy in the last few years, repurchasing a lot more stock, taking on a lot more debt.
Yep.
So that's where I think we see the most concerns. But, Then again, look, Barclays and Citigroup have a big credit card relationship with them. It wouldn't shock me if we saw a few $1 billion of forward miles purchased from these banks. They also have term facilities that we think they could actually stretch out. So there's lots of options on the table here. CapEx is going to get pushed out. Everyone's going to feel this throughout, the aerospace system too. So deliveries won't happen. But I don't think any of these companies are actually going to go bankrupt through this crisis.
Well, the fact that you have to say that tells us just how bad it is out there. But Brandon, we appreciate it. Like you said, liquidity stress test for all of these companies. And American, maybe the poster child for investors being upset about those debt-funded buybacks. We'll leave it there, Brandon. We'll check back in with you soon. Brandon Oglinski of Barclays. And from the air to the sea now, this pandemic has been devastating the cruise industry too. Princess and Viking Cruises today suspending global ship operations. For more, let's get to Seema Modi. Seema.
Kelly, that's right. Carnival announcing it's halting operations of the Princess Cruise Line, 18 ships in total for about 2 months. This will impact sailings scheduled from March 12th to May 10th. And it follows 2 high-profile quarantines, the Diamond Princess off the coast of Japan and the Grand Princess off the coast of California over growing coronavirus concerns. The Princess line accounts for roughly 20% of Carnival's EBITDA. According to analysts at Instinet, the stock, Carnival, down about 17% today. Experts say they wouldn't be surprised to see other cruise lines follow Princess's decision. In fact, Viking, an operator of luxury river cruises backed by private equity firm TPG and the Canadian Pension Fund, suspending all sailings till May 1st. This is, of course, a private company, but you're starting to see the fallout spread as well, Kelly. It's not just the cruise lines. You take a look at the hotel operators, the online travel names like Booking Holdings and Expedia, all seeing significant losses in today's trade.
I don't know if we can show the year-to-date declines for these cruise operators, Seema, but Norwegian's now trading at $11 a share.
Yeah, that stock is been hit really hard, not just today, but Norwegian suffering the most if you look at the year-to-date performance of Royal Caribbean, Carnival, and Norwegian, the 3 publicly listed cruise operators.
Norwegian's down 80%. Yeah.
Year-to-date, exactly. And following that, you'll see Royal down, I think, about 70%. Carnival actually, interestingly enough, despite the high profile and negative attention that it's received with the Princess line, it's faring better on a year-to-date basis.
All right. Seema, thank you. We appreciate it. Seema Modi. It's been a wild session here on Wall Street. The S&P circuit breaker kicked in for the second time this week that halted trading for 15 minutes. That was shortly after the open this morning. The Dow was down 2,200 points at the lows. It went up to a decline of about 750 after the Federal Reserve came in just before the turn of the hour with an emergency liquidity announcement. But we've slid back down now. The Dow's down 1,800 points. That's a 7.6% drop. The Russell 2000 small caps are down more than 9% today. The 10-year yield, which again, as of yesterday, was kind of uncoupling with these markets and had moved higher, is standing about 71 basis points right now in the wake of all of this. So it's kind of chopping around. Crude oil has been crushed again, I should say. Big declines across Brent and WTI. There's WTI down 6%. It's just under $31 a barrel. The industrial ETF is on pace for its worst week since September of 2001, with more than 11 members down 10% or more today. That includes United Airlines, Boeing, General Electric, UTX, Delta, and American Airlines. Fast-moving news here. United's down 18%. Let's get to Sue Herrera for a news update at this moment. Sue?
And there's a lot going on at this point, Kelly. Just moments ago, the announcement came that Sunday's Democratic presidential debate is being moved from Phoenix to Washington, D.C. The organizers are making the chance to reduce the coronavirus risk because Univision's moderator, Jorge Ramos, is pulling out of that debate because he was recently in contact with someone who tested positive for the coronavirus. Canadian Prime Minister Justin Trudeau is self-isolating after his wife Sophie began showing flu-like symptoms following a trip to Britain. The couple are staying at home pending the results of her test for the coronavirus. National Guard troops a short while ago began handing out supplies in New Rochelle, New York. There's currently a 1-mile containment zone in an effort to curb the coronavirus outbreak. New York's governor calls the area the most significant cluster in the country. The containment zone is set to continue through March 25th. And Major League Soccer has suspended all games for the next 30 days because of the coronavirus. The league says it will continue to monitor events as it works on plans to try and resume the season. Just one of the latest sports teams and leagues to announce that they are either canceling or suspending because of the virus. Kelly, back to you.
Yeah, their headlines are coming in fast and furious. Sue, thank you. And the Fast and Furious movie's now been suspended a year. Anyway, as Sue mentioned, the world of sports is coming to grips with a new reality during this pandemic. Let's bring in Eric Chemi with all the cancellations and suspensions up to this point. Eric, just the last few minutes, we're hearing from the Major League Baseball and National Hockey League.
Yeah, that's right. So the NBA, they took the lead last night. That was followed by a host of other sports entities today. Major League Soccer, ATP Tennis, college sports, and so on. They've all announced cancellations or postponements to their seasons. We've been getting a new one basically every few minutes in this past hour. These sports industries, they're massive businesses. Consider just the NBA. It brings $9 billion in league-wide revenues every year. $4 billion gets paid to the players. $3 billion comes just from its national TV rights deal with ESPN and Turner. You add in the PGA, which will have tournaments still, but without fans. Major League Soccer, they're now suspended. ATP Tennis Tour, that's suspended. That's billions of dollars more. And then just in the last few minutes, we're hearing that the Major League Baseball, that spring training is now being suspended, and National Hockey League, they are suspended. Those two alone, that's combined $16 billion a year. And all the major conference basketball tournaments, they were canceled today. One game was canceled at halftime just about a few minutes ago. But the one big thing we're waiting for, that NCAA March Madness tournament, they have still not canceled that tournament. They make $1 billion a year just from those 3 weekends.
Yeah,
so
now we'll have ripple effects back to the schools. Eric, hold that thought and stick around, because the growing list of leagues suspending games or banning fans is likely to have a huge financial impact. And our next guest says there's not even a way to quantify it right now. There's no precedent. There's no playbook for this situation. George Pine is here. He's the founder and CEO of Bruin Sports Capital. It's great to have you, George. I mean, what is business like on a day like this?
It's tough right now, and it's unknown. I think in the long run, it will sort itself out over a long period of time, but in the short run, it's going to be very choppy. And the places to look first, as Eric mentioned, the NCAA, the NBA playoffs, the NHL playoffs, sports that are in the playoff run, that's where the money's made. That's the most profitable time of the year. So those sports are in the toughest position. Things like Major League Baseball, they can delay the season. They can add double headers. They can extend the season. But those sports that are in the playoff run, it's going to be difficult. Lastly, the local people in the communities.
Sure.
Restaurants, bars, people that collect tickets, security, those people are going to be hit hard too. So it's a very difficult situation.
And at least the NBA has major TV contracts. Hockey, as I understand it, I mean, they're making money from primarily who's in those seats. So losing this era could be a huge blow.
Matters more relatively to hockey than it does the NBA. March Madness, it's more about the TV revenue. But what's interesting to me is you notice the difference between indoor sports and outdoor sports. Obviously, George was an executive at NASCAR. So NASCAR and golf, they're going to still keep going just without fans. Those are played outside. So maybe they think, okay, you're not trapped inside. So we'll see if they change their tune in the next couple of weeks.
And think about, I was talking to an NBA team president today. It's $3 to $5 million in gross revenue per event. So if you have 10 events a night, that's 30 to 50 million.
And there's about
doing
10 home games left for teams.
Right, and then you play 3 games a week. That's $200 million out the window on one sport. Then you put in the NHL and these other games. It's a meaningful impact locally.
What about the NBA players themselves? So both for NHL and NBA, this will have repercussions on their salaries for next year, won't it?
It will have some impact, but I think the players, the TV networks, the leagues on the media side, that'll get worked out. I mean, if you have a $24 billion deal, you'll figure out a couple $100 million. It's the local market, the local teams, and the people locally, they're going to get hit the hardest.
Do you guys hear anything from, a lot of stadiums have now been financed by municipal debt, and I just worry about if gate revenues there are down. And I know they typically would have offsets, but not if you're not having large gatherings of any kind right now. I just wonder about kind of the ripple effects throughout the stadium financing market.
I think for a couple months, I think you probably work your way through it. If this is prolonged, 12, 18 months, that would be different. But I think over 3 or 4 months, you probably get your way through.
What about, I know your kids are college athletes, one in high school about to be a college athlete. How are they dealing with this? Because you're seeing the Ivy League canceled all sports. A lot of these college football programs are starting to shut down. How are you just dealing with it from your own family?
It's tough. I went to Brown. Brown beat the national champion Virginia lacrosse team. My best friend's dad, son, is the captain of the team. All of a sudden, he gets a note. He worked all year to play on this team, and they're not going to play ever again. Right. It's his senior year. So I think.
What if you're a junior in high school who's being recruited and you have no season? I mean, I don't understand.
These things have real consequences. So having run a league before, you have to look at it from all aspects: the competitor, the state, the local government, your TV partner, sponsors, the health of your employees, the health of the players. it's a whole bunch of inputs, and you got to weigh them and make the best decision you can.
And as you guys have said, the major kind of outlier right now is March Madness. There is so much at stake here for whether they cancel. As of right now, they're going to play it, but with no one in the stadiums.
Which is what a lot of the conference tournaments said a day or two ago.
Exactly.
And then all of a sudden today it was, okay, forget it. We're not even going to play empty.
And it's a money thing, because when you think about it logically, they have a TV contract for 2032. So yes, it's $900 million in TV revenue, but over that length of a deal, I'm sure you can figure it out. So it's balancing the desire to collect the $900 million versus the other issues.
And I guess it depends on where those losses are going to come down. Who would bear the losses, and is there insurance for anything like this?
Well, I just think you could work it out over the course of your TV deal in the worst case scenario, but people that are going to get hurt, all those facilities that are going to host the games, those companies that did the ticketing and hospitality packages, how does it work with the sponsors? I think it's less of an issue really for the NCAA and more of an issue for the people that live in the ecosystem.
Didn't one of your investment companies have something to do with Mercedes-Benz in Atlanta, and that's where the Final Four was going to be, I think, this year, right? And it's like, oh, maybe we need to go to a smaller venue. We don't need a football stadium if no one's coming.
Anybody who's involved in the event business is going to take a hit. The question is it how pronounced is it long-term versus short-term? I just think it's the short-term hits, and really the working person is really going to get, who's the security people, the ticketing people, the food service people, all those local small businesses. This is real revenue to them, and it's not going to be there.
Yeah. Guys, thanks. George Pine, we appreciate you coming down today. Our own Eric Chemi as well. Let's take a look at the markets right now, because we are headed back towards session lows. The Dow's down 1,800 points, or nearly 8% right now. Remember, after we triggered the 7% circuit breaker the first time, it has to be a down 13% to trigger it a second time. The S&P is down 7%, the NASDAQ just shy of that level. The ITB is the home construction ETF. You might think it would do better with lower rates, but it's on pace for its worst day since the housing crisis. Down 11.5% right now. Our Diana Olick is in Washington with more. Diana?
Kelly, several things weighing on the builders today. Mortgage rates fell to a record low last week, but are now moving up again as lenders try to deal with the onslaught of refinance demand. A pretty big jump, actually, yesterday for the 30-year fix. In addition, Bank of America downgraded Lennar, Toll Brothers, and NVR, saying that while they're still bullish on housing, quote, we would be remiss to assume no impact on end market demand from COVID-19. Toll Brothers, in particular, a luxury builder, will be impacted by the massive drop in the stock market. It's already down 50% from its 52-week high. B of A is also tempering its forecasts for repair and remodeling. Demand and demographics are all very favorable for the builders, but there is concern that their labor force, which was already very tight, could be hit, and then possibly supply chain disruption for products coming from China. Kelly?
Diana, the other question, which our Robert Frank has reported anecdotally, open house showings in Manhattan are falling because people are worried about gatherings. My neighborhood ones were very busy this past weekend, but we know these things can change quickly. Any sign that the next few weekends it might be a little tougher out there?
Yeah, we've been calling around to realtors all over the country, and as you know, all real estate is local. So while one agent in Texas said everything is great, an agent in LA said the same thing, obviously in Seattle you are not seeing that. Actually, in this area, you're seeing open houses being canceled. Also, Redfin recently said that they would be willing to do Skype tours of the house. That is, the agent in the house and the person on the Skype, so the agent could walk around and answer questions without the potential buyer actually being there. So it's going to be changing very quickly, and it will, of course, depend on where you are.
All right, Diana, thank you. Diana Olick. Let's turn to the restaurant stocks today. Darden and Brinker International are down double digits over the past month, along with the sector. Today we had Starbucks announcing it's considering several safety measures, including social distancing, by limiting seating at its stores. Let's bring in Jim Ballas now. He's Managing Director of Strategic Operations Group at Capital Spring. That's a private investment firm focused on the restaurant industry. Jim, it's good to see you. So restaurants, the trouble is, if you don't take your trip to some country this year, you might take it next year. The restaurant visits that are lost because of coronavirus, they're probably not going to get back, right?
Yeah, that's true. I mean, it's definitely going to be challenging for them. What you're seeing here is a clear migration from people dining in the restaurants to people using it very differently to off-premise. So you're seeing people using drive-thrus, delivery is obviously picking up. So those businesses that have those available to them as revenue channels are performing a little bit better currently than those that have dine-in.
Sure, and that reminds me of our last conversation about the ripple effects of these sports cancellations on a lot of the people who might have worked as security or in concessions and so forth. If people are ordering and off-prem, they're picking that food up, they're doing delivery, that's fine, but the wait staff, what happens to the wait staff if nobody's dining in these places?
Yeah, it's very difficult for them, and obviously a lot of them, work paycheck to paycheck, and so they're much more challenged when the business suffers. The other problem that you have to remember is, the restaurant business is I think it's the second or third largest employer in the country. And so any impact to the restaurant business and the employment of the restaurant business, has ripple effects throughout the economy.
Tell us how your business works. You finance some of the franchisors, is that right? Or with a lot of different names that we know very well, Wendy's, Panera, and so forth.
Sure. Yeah, we're a little bit unique. So we both provide equity and debt to restaurant companies. And in some situations, those are independent concepts. And in other situations, those are franchisees of businesses and some franchisors as well. So we're a sort of a creative financing solution for the restaurant space.
I can imagine your returns aren't going to be what you thought they were this year then. Whether it's on the equity or the debt side. Now, maybe the long-term valuation shouldn't be changed, but are there going to be cash flow issues from these companies that just don't have the people coming in the door they thought they would?
Fortunately, most of our focus has been on what we call the quick service or fast food space, and those tend to be faring a little bit better because they do have drive-thrus. They're able to close the dining rooms and just have drive-through or delivery. And so because of that, hopefully we'll fare a little bit better than others.
We got to talk about worst-case scenarios now, because you look at a country like Italy, and again, as Scott Gottlieb has said on our air, it's kind of too late for us to be like Korea. So now Italy becomes one possible path we go down, where they've shut almost everything down except grocery stores and pharmacies. What would happen with some kind of business disruption like that in this country? Do you think they would ever shut down restaurants, or is there a way to make sure that they can stay open for people who rely on them, to your point, and make sure they're operating safely?
I would hope so. Obviously, these are uncharted waters. We're in the early innings here. We don't know what's going to happen. Should we have a situation like Italy, we're going to have to deal with that when it actually occurs. But, we don't believe they're going to shut down the restaurant business at this point. In some ways, restaurant food is a little bit safer than what you make at home, because we take so many precautions around safety and sanitation, whether it's cook temperatures, just what the very specific policies that we have for our workers.
And what for the business model? So now if I'm going to go and do pickup instead of dine-in, if I'm going to try for delivery, what are some of the lasting changes you might anticipate here? Does it create different winners and losers? Do you think some of these behaviors might be sticky, so to speak?
Yeah, I think what's going to happen is once eventually this hopefully will blow over, and we'll see people come back just like any other crisis, whether it's, a hurricane or, some other catastrophe. And, we see restaurants bounce back very strongly. I think you're going to see, you mentioned a couple of names earlier around Brinker and Darden. Those tend to be casual dining, with servers and, restaurants with waiters and waitresses. Those are going to suffer a little bit more unless they can migrate and do more off-premise.
Absolutely. That's what I was wondering is if you're them, do you try, because that food often doesn't deliver well.
Yeah, you're right.
Are there menu changes they could make to kind of enhance and say, look, you know our menu, you love it. We're going to offer such and such tweaks right now. So if you just want to come and pick that up, we're going to make sure that it's hot. We're going to make sure that it's, it travels well, so to speak.
Yeah, I think already they've made those changes as the business in general, even pre-coronavirus. So we're seeing the businesses tailor their menus to what travels a little bit better. Obviously, you're seeing a lot around packaging for safety reasons. We're putting stickers on bags as they go out, or, we're recommending to the vestments that we have, they take certain precautions, or stickers over the boxes for pizza boxes to make sure they don't get tampered with. So you're going to see some actions around delivery, but certainly the menu items too. Those that travel better, they're going to lean into those items.
Yeah, chicken wings or something. I don't know at this point. Jim, thanks very much. It's good to see you today.
Thanks for having me on.
Jim Ballas of Capital Spring. Let's take a look at some of the worst sectors in the market right now. It's not easy, not hard to find them, I should say. They're energy, financials, and industrials. Energy's down more than 9%. The financials down about 8%, and industrials down about 7% today. The worst individual Dow performers are emblematic of this to some extent. They include Dow Chemical, American Express, and IBM, all down more than 10%. And all 30 Dow stocks are lower right now as the index, as I said, is down about 7.5%. And as the scramble for cash intensifies, liquidity concerns are throwing the global bond markets into turmoil. The Fed announcing at the top of the hour they will begin a bond buying program. Let's bring in Ian Lingen. He's head of U.S. rate strategy at BMO Capital Markets. It's terrific to have you here. We just need the voice of authority about what is happening in the Treasury market and whether the Fed's announcement is going to solve that.
Well, thank you very much for having me on. It is an exciting day in the Treasury market. The Fed is getting involved, but they're getting involved in a very subtle way. They were already buying $60 billion worth of Treasuries. This is simply reallocating out of bills into coupons. Now, that's important because it does suggest that they're going to probably end up doing more very soon.
Explain that for a second. So this is not necessarily new money into, let's say, the economy. It's not new quantitative easing. It's just a different kind. What does that tell you about why would they make a step like this?
Well, they're worried about the market assuming that when this program ends, which it was scheduled to end relatively soon, that they're over and they're out of the market. And it's very clear that the market and investors need the Fed to step up. They're going to cut rates to zero. They're going to do that next week, and they're probably going to announce another QE program at that point.
Now, to me, the biggest question is cause and effect here. You know, we can go back to the emergency rate cut. I don't even know how many days ago. It was just last week, I think, last Tuesday morning. Markets have deteriorated significantly after that rate cut. Is the Fed creating this problem or solving it? Because some days I can't tell.
Well, the Fed is doing everything that they can to buy time, because that's really the name of the game at this point. The Fed wants corporations to have access to funding. They want the banks to have access to funding. They want to provide an opportunity for the primary dealers who had been disintermediated from making markets. And this is part of the liquidity issue that we're running up against right now. They want to make sure that that money's there and the market's going to keep functioning. Have they created the problem? Not at all. What they're doing is they're doing their utmost to make sure that it doesn't become anything like the financial crisis.
Why did liquidity evaporate? Because to me, it looked like Fed cuts rates, it's not enough, market panics, yields plunge. And when yields plunged, like last Sunday, 10-year below 35 basis points, you heard a lot of talk about wide bid-ask spreads, about terrible liquidity. Is the level related to the lack of liquidity here? In other words, people just can't figure out the prices. Or is it because the central bank is tamping down any need to trade the market because they're effectively telling you it's going to zero? They're going to be, cutting rates to zero and then bond buying.
I would actually argue that it's a function of a lot of the regulatory changes that happened after the financial crisis. What's going on at this point is banks aren't willing to take the risk. It's not the absolute level of the move, but it was the severity. When you get a move that is that significant, people want to step away and they want to say, I don't think I'm going to bid that because I don't want to be involved right now.
Yeah, we spoke to Chris Repke on Power Lunch a couple days ago, and he said he thinks the government bond markets are going to be fundamentally broken. And he's a fixed income strategist guy, so this is him, panicking about his own future. I mean, to some extent, are these problems becoming existential?
Yes and no. Price action, when it exists as long as this has, becomes a problem unto itself. If this move had simply come and gone, and it was the V shape that everyone was expecting, we wouldn't be worried about bank liquidity. We wouldn't be worried about some of these dislocations in the front end. And the fact of the matter is that people are selling longer-term treasuries and parking money in cash. And that's why you see a lot of this counterintuitive price action. Yesterday was a great example. You had treasuries off, you had stocks off. That doesn't make any sense.
Right, that was not the paradigm. We all talked about this in the afternoon. The Treasury 10-year yield started to come back up, but stocks did not follow. And that tells you that something's broken. So what do you guys think is going on here?
I think that we are very much in a panic mode. There's a premium being put on liquidity. If you look at the spreads between the on-the-run and off-the-run treasuries, that's very evident. That's a typical tell and something that we're going to continue following. There will be a point where there is a true sense of calm in the market, and hopefully that comes before the Fed. If not, then directly after it. Right.
So last question here. The markets looked better in the immediate aftermath of this cut than they do now. We're kind of back to the lows. Do the Treasury markets look better to you? I know it's only been an hour, but do you think they're doing enough here to really kind of help solve this challenge?
Well, from my perspective, the Treasury market looks better because rates are and I'm expecting negative rates in the front end of the market. I think that will be a reality for the Treasury market a lot sooner than the forwards are pricing in.
All right, so to you, negative rates is a good sign. To me, it looks like, the apocalypse or something. Is that where we're headed on the 10-year too?
We're going to go right up against zero. Whether that's 25 or -5 remains to be seen.
Ian, thanks for coming in.
Thanks.
We appreciate it on a day like this, especially. Ian Lingen from BMO Capital Markets. And that does it for the exchange today. Thanks so much for tuning in. I will see you over on Power Lunch. Here's Tyler.
And Kelly, thank you very much. Welcome, everybody. I'm Tyler Matheson. We start today on Power Lunch with, of course, the massive market sell-off. The Dow Industrials off right now about 1,600 points, swinging wildly after the Federal Reserve stepped in to inject $1.5 trillion. Yes, you heard me right, $1.5 trillion into the system. But virus fears around the globe are outweighing that relief for now. It is a yo-yo kind of day. Stay tuned. And just to put this all into context, the Dow is down about 16% or thereabouts this week. Let that sink in for just a moment. 16% just this week. And we're not even done. President Trump announcing a travel ban on all non-U.S. citizens coming in from Europe, but we're still awaiting details on a stimulus plan or a domestic response to ensure containment, mitigation, and increased testing capabilities right here in the U.S. And we're talking to three CEOs today. Group 1 Auto, Redfin, also Verizon CEO, about how these companies are dealing with the fallout and what the impact of this virus will be on the overall economy. Kelly?
All right, Tyler, thanks. Let's get right to our reporters covering this story for us. Bob Bassani is watching another huge drop for stocks today. Rick Santelli is monitoring the action in the bond market after the Fed's big move. Eamon Javers is looking at the government response, and Meg Terrell bringing us the very latest on the coronavirus outbreak. Steve, we begin with Steve Leisman, who's on the phone with the latest on this move by the Fed. It's been about an hour, Steve, for markets to digest it.
Yeah, and people are still trying to figure it all out here. It looks like what has happened is the Federal Reserve is going to do a series of massive operations to put, put it this way, it will be $1 trillion a week of liquidity in the following ways. Let me go through this. $500 million was done at 1:30 today. That was a 3-month repo operation. $500 million in a 3-month tomorrow.
$500 billion. $500 billion each.
Yes. $500 billion. Sorry, did I say $500 billion? I'm sorry. $500 billion in each 3 separate operations that will amount to, I'm told, $1 trillion of new money a week. I think what the Fed's trying to do here is to just put infinity out there and just make available what the market needs. And the reason it says very specifically in its statement is because there have been unusual disruptions in Treasury financing markets. Spreads have blown out in ways, guys, that we haven't seen since 2008. In certain derivative markets, certain securities, they're actually wider than they were in 2008, suggesting more concern out there. And the Federal Reserve hopes by doing these operations, it will provide as much money as is required for the smooth functioning of the markets. Whether that'll be enough, I don't know. I've heard people complain that the real problem is the lack of balance sheet out there. And you saw that the European Central Bank did something different today where it reduced the reserve requirements in certain areas. The Fed is not doing that yet. They may yet think about that. And just one other thing on this. This was done as part of a certain power that the Fed chairman has to take an operation like this. They say it's done in consultation with the FOMC, but not a decision made by the committee. Apparently, they've run a series of calls between John Williams, the head of the New York Fed, and the Fed chairman, and all kinds of staff, and the New York desk, which does these sorts of things. They have been on the phone continuously for several days, I'm told, and this is the result of those calls in an action taken by the chair with instructions to the New York desk. So a very unusual operation, and certainly a massive amount of it.
Steve, can I ask you a question here? Because, and I think you answered it, but we have the operations of the Fed taking place today, and then in 2 more tranches tomorrow, and then in the statement it says 3-month and 1-month repo operations for $500 billion will be offered on a weekly basis for the remainder of the monthly schedule. Does that mean that the Fed is going to be in the market buying at a rate of $1 trillion a week for as far as the eye can see? What does it mean?
Yeah, I think you have it right there, Tyler. And I was on the phone with somebody in the bond market And we were trying to total all this up, and we came up with a number of $2.5 trillion, which I was afraid to say until you started doing that math right there. But you could do the math in a lot of different ways, but it is just an enormous amount of money. It is basically saying that if you need to do this operation of repoing securities, that there will be enough out there for you on offer from the Federal Reserve. I don't know the extent it gets at the problem, because we've had, guys use words like, the guest that Kelly just had on was extraordinary. We talked about panic in the bond market and some of the things that I'm hearing, which is the differentials between the futures market and the cash market are as wide as ever, with potential impacts on the corporate bond market. So we're going to have to wait and see. But I don't think the Fed intends this to solve the problems of the economy. It's not intended to solve the problems of the virus or anything like that. It's intended to solve a specific issue such that wherever the bond market needs to go, they can get there with sufficient liquidity. And that was a problem. So it doesn't solve any of the overlying problems, just this one idea.
The problem in the bond market and liquidity and the mismatch of bid and ask that you pointed to earlier this week. Steve, we're going to leave it there, and we'll, I'm sure, be talking to you throughout the rest of the day. Let's get to Bob Pisani now at the New York Stock Exchange on this wild day, where prices have certainly been yo-yoing, and that's a polite way of putting it.
Tyler, 23 years down here as the stocks correspondent, and I don't think I've ever seen the S&P move 6% in less than 15 minutes. I want to emphasize less than 15 minutes. Here's the Fed announcement right there, around 12:51 or so Eastern time. There we move up, so it's 25.06 to about 26.60. We're talking about 160 points. That's about a 6% jump. You're not going to see that. You can go many, many years without seeing that. And some stocks even went positive. Johnson & Johnson, typical market, was down about 6%. Look at that, straight up, and actually went positive. You can see we're drifting lower here. By and large, the trend is still intact here, and that is the global takedown of the market multiple. It doesn't really matter here. You're looking at 6, 7, 8% declines here. There's even the defensive names are essentially down, consumer staples along with industrials. It doesn't really matter. Let's not quibble about a percentage point or two. Where is the bottom? My old friend, Art Cashin from UBS, calling in, recuperating from an auto accident, sends his best wishes to everyone. He's watching right here. There's the December 24th, 2018 low. That number is 23.51. And that's an important number. Why? Because we're only 200 points away from that. Hey, we did that today, folks. And that, interestingly, is a 30% decline from high to low. Why is that interesting? Because that's your typical bear market decline for the S&P, 30%. In the great financial crisis, we had a 50% decline, but that is a big, big outlier. So look at that 23.51. By the way, a lot of people say, well, we weren't impressed with President Trump's speech last night. We weren't impressed with the Congress today, not getting its act together. They weren't impressed with Christine Lagarde either. There you see the stock 600 closing at the lows for the day. Despite what they said, bond buying, market wanted a lot more, even from Europe. Guys, back to you.
All right, Robert, thank you very much. Bob Pisani at the NYSE. Let's move over to the bond market now, where yields are falling, and Rick Santelli is tracking the action at the CME. Hi, Rick.
Hi, Tyler. And indeed, Steve Leisman, of course, in your discussion, showing there's so much liquidity, at least for the gears, but that really doesn't change the fact that there's a lot of dynamics that are still hard for the market to wrap their arms around. If you look at a week-to-date of two-year note yields, we're creeping back over that 40 basis point where we were stoic yesterday. That's a good sign as it sits at 43, 44 now. It's only down 8 basis points. If you look at 10s, can we get up to yesterday's 88? Does that really matter? What the point is that we really are in this range, and as long as we stay above some of the major lows, like 31 basis points, the low from Monday's intraday, trading down here seems pretty orderly. The auction wasn't very pretty for 30-year bonds, which by far seem to be the most buoyant, which makes sense. And finally, foreign exchange. What a day. Now, look at the dollar index there and note that the minute we went through unchanged, right around 97.39, we had a deluge of a 2.5% drop. Well, now we've rallied all the way back as we hover near unchanged again. Look at a year-to-date of the euro versus the dollar that expresses it the best. The euro benefited from that drop in the dollar, but it isn't benefiting from the big rally today and yesterday, as the euro, after all today's volatility, is darn close to where it settled for 2019. Kelly, back to you.
All right, Rick, thanks. Rick Santelli, the president, saying today he's not yet invoking emergency powers in regard to the crisis, but now the Senate is canceling its recess. Let's go to Eamon Javers, who is at the White House, I should say, with the very latest. Eamon?
Yeah, Kelly, last night you heard the president announce that partial travel ban from European countries coming to the United States. Today, as you point out, he was asked in the Oval Office whether or not he's considering any domestic travel bans. The president said he didn't think we're there just yet. He said he would consider it if needed, but specifically around some of the hot spots like in New York and in Washington State, but not there just yet. The president was also asked if he's going to declare any kind of national emergency or disaster under the Stafford Act, which gives the federal government broad powers. The president said this in response.
And if I need to do something, I'll do it. I have the right to do a lot of things that people don't even know about. Are you going to do that today? Well, I don't want to say that, but, at some point, it may be some of the more minor things at this point.
So you hear the president there, Kelly, saying some of the more minor things at this point. He's not specifying what he's talking about there, but my guess is he might invoke pieces of the Stafford Act, not clear which pieces he's talking about necessarily, rather than a broad national disaster declaration, and also resisting any kind of domestic travel restrictions for the time being. This is a president who very much doesn't want to overreact to this crisis. He's taken some heat for that, but he's being consistent today here and suggesting that he might do some of the more minor actions, but not the broad sweeping action that some people are calling for, Kelly.
I know I am certainly not, and I don't know whether you are familiar with the Stafford Act. What kinds of powers or emergency abilities does he have under that?
Well, the main thing is we're told it would free up about $40 billion worth of federal disaster funds immediately, and it would put the FEMA folks in the fight effectively right now. The president's talked a lot about having the states do this rather than the federal government, but FEMA has a role to play here. FEMA does a lot of things like disaster recovery, debris removal, and things like that won't be needed here. There is an unemployment piece of FEMA, though, and that could be something that might be key here if a lot of workers aren't able to get to the office and take a financial hit.
All right, Eamon, thank you very much. All three of the major indexes sinking deeper into bear market territory. The headline on the Wall Street Journal this morning, the Dow's long bull market is over. The major averages down 25% from their highs, with no end in sight right now to the selling. Let's bring in Larry Adam, Chief Investment Officer with Raymond James, and Michael Cloherty. He's UBS's investment bank head of U.S. rates strategy. Mr. Cloherty, let me begin with you and get your reaction to what the Fed is doing, since you follow rates and presumably the Treasury market as closely as anybody. What do you think of what they did? Will it have the desired effects?
So again, what they're trying to do is try and fix a market functioning issue. Treasury market liquidity and off the runs has been the worst it's been since 2008. Wild dislocations in here, and the problem is, we're supposed to be the boring market. Everybody's happiest when we're very dull. When you start to see drama in the Treasury market, it spooks people in lots of other markets, and you get this cascade effect all the way down. Unfortunately, we don't think the Fed's buying that they're going to do is big enough to fix the underlying issues in off-the-run treasuries here.
And what are the underlying issues that need fixing, and how could you do it?
So there's basically three steps to this story. So first, you've and other people have talked a bunch of times the past few years about mutual funds promising customers next-day liquidity, but owning some assets that would take a while to sell. So their response has been, I want to hold more cash. The easiest way to hold more cash is, instead of buying off-the-run treasuries, I buy a futures contract that gives me the same risk, but then I keep my cash. So when they do that, somebody has to take the other side of the trade, and that's hedge funds have been on the other side of this trade. So you have this massive hedge fund position where they're short these very rich treasury futures, long all these off-the-run treasuries. It's a trade that worked great for the last 2 years for them, but now when you have the market moving violently, liquidity decaying, they've started to get squeezed on that position, and we've been seeing more and more stress. Fed is hoping that by coming in buying some of these off-the-run treasuries, they'll provide a backstop and allow those hedge funds to work their way out of that position over time. Problem is, the position's so big, you're going to have to do more.
Michael, for me, the bigger picture beyond the short-term liquidity issues is the simple fact that the Federal Reserve is going to be cutting rates to zero. Yields are going to go negative. I don't know how far out you want to take it, but it seems inevitable at this point. And they're going to be talking about buying a whole lot more stuff from here.
Right. I think today was step one. We'll be waiting to see if we get step two with the FOMC in next week. Again, just to push back a little bit on negative rates,
It's a lot harder to do in the U.S. because we have a $3.7 trillion money fund industry whose business model gets severely strained at rates.
Let me be clear, though,
zero.
Michael. I don't mean taking the Fed funds rate negative, which I understand, and Rosengren talked about this on Friday. He doesn't think it'd be good for the banking system, et cetera. But they don't have to take the funds rate negative for the rest of the curve to go negative.
Well, they'll try and keep repo rate negative. I mean, the rest of the curve could go negative for a day or two, but when you're losing money by holding a position, it's hard to stay there too long.
Fair enough. What would you say then to people who talk about openly about the 10-year Treasury, and we talked a little bit about this last hour, maybe at 5 basis points, maybe at 0? I mean, what do you think is truly feasible at this point?
So we think it's going to head to 0.5%, get down to 50 basis points, and peter out there. We do think we'll see the Fed. We do think the Fed's going to pull out all the stops. So we think they're going to head to very close to 0. We think they're going to provide guidance to say we're not going to tighten rates for a year and a half, 2 years, and we think we're going to see QE. So they'll unveil everything. We'll see markets, lower significantly, and some of the volatility we've seen get dampened down a bit. Yep.
Let me bring Larry Adam into the conversation here and pivot a little bit. I mean, you can talk about the bond market if you want, Larry, but specifically on the equity side, it would seem to me that it is almost impossible to put in a floor until there is some more clarity on this epidemic peaking and until we learn something more about corporate profits. If you can't figure out what the E is, how can you figure out the P?
So I agree with you that there's going to continue to be a lot of volatility around all the headlines that you just mentioned. But I think for longer-term investors, I think you can get a pretty good gauge of where you think earnings are going to be and what's priced into the market right now. So, for example, if I look at the equity market right now, I actually think it's pricing in earnings for the next 12 months of $130. I don't think that that's likely. Our worst case scenario is that it's $150 over the next 12 months. So I actually think you're entering a place where you're seeing some good opportunities for the equity market for longer term investors. One other example, if you look at dividends, I think the market right now is pricing in a 15% decline in dividends this year. That doesn't happen. I mean, even if you go back to 2001 to 2003, it was only 5% reduction in dividends. So I think the market's overreacting here, but I agree with you that it's impossible to try and pick a floor or a bottom.
Is your estimate of 150 on S&P earnings, is that contemporaneous? In other words, is that right up to today or what?
It is. So we began the year north of 170. We brought it down to 167. We may have some modest adjustments from there. But I don't think you're going to see, we do scenario analysis, and 150 is where we think is the worst case scenario for this year.
And Michael, let me turn back to negative yields and harass you about it just for another question or two, so I make sure I understand this. If the Fed's going to be they're going to 0, then they're going to start buying bonds, presumably as part of QE. They're willing to basically pay any price. I'm not hearing them say, we're only going to buy, treasuries up to such and such a price. So I guess my point is they are going to be the buyer of last resort for treasuries. Why wouldn't I be comfortable for the next little while with the potential that longer dated treasuries could have negative yields in that case?
So I think the problem is the Fed's going to be buying a lot, but the Treasury is also issuing a lot. We've got, we were running on $1.25 trillion financing need for this year. Before we even have any, impact from the slowdown, taxes will be softer, things like that, and any new spending. So that, you will have more demand, but you're going to have more supply too.
Yeah, although that is doing nothing to kind of dampen the buying appetite now. In fact, I've heard people saying that we should be issuing way more debt because there's such a huge appetite for U.S. treasuries. I mean, maybe that's the most likely thing to come here when we get this big fiscal stimulus announcement, right?
Right, you'll have to have some stimulus with that, and we'll see where on the curve they choose to finance that.
All right. Gentlemen, we appreciate it today. Thanks.
Yeah, thanks.
Michael Flaherty and Larry Adam. Well, President Trump's travel ban has sent the travel stocks plummeting today. It's one of the big reasons the market's down so much. Cruise ships getting crushed, Norwegian, Royal Caribbean, and Carnival. Get this, all of these three names are at least 70, and in Norwegian's case, 80% down from their 52-week highs. The airlines are also tumbling. United and Southwest are down more than 15% right now. United is down 18%, and hotels are deep in the red. Just look at Wyndham, which is down 9%. Hyatt down nearly 13%. Wyndham and Hilton are on pace for their worst week ever. Let's bring in Priceline founder Jay Walker on that happy note, Jay. But listen, you are a solutions-oriented guy. Never met a challenge he couldn't face. What do we do about coronavirus?
Well, I think the first thing we're going to do is recognize it's a new reality in the market. You know, when you cancel, the Big Ten tournament, you cancel the NBA, people say, whoa, this is the real thing. You know, you can argue about what's real and not with a virus, but you can't argue when things everywhere, school is closing. And a new reality is what you're seeing pricing in the market. A new reality is what you're seeing in the travel world. Travel is a voluntary activity. People don't do voluntary activities when they are afraid. The government has basically said we're going to balance the health of the nation against restricting or slowing down the spread of the virus. Trump said from the start, I'm going to balance it for the health of the nation. And that's exactly what he's done. The travel sector's on the wrong side of that trade for the time being, because what they're trying to do here is to slow down the spread. They're worried about the healthcare system. They're worried about the hospitals being overwhelmed by the worried well. They're trying to flatten a different curve. You guys deal with the yield curve. Guess what? In the U.S. government, they're talking about the health curve. They're trying to flatten and push that curve out so that the hospitals don't get overwhelmed. That's a smart strategy for the United States.
You know what I honestly think? I honestly wonder if we shouldn't just declare a 2-week national holiday. I mean, you can interpret that however you need it to be interpreted. But in other words, it doesn't take us the way of Italy yet, where everything except grocery stores and pharmacies are closed. But it's a chance to take a breather, let the hospitals catch up with what's happened already.
You got people who live paycheck to paycheck. You take a 2-week holiday, how are they paying their bills? Until the government puts in a plan for the bottom of the pyramid to be able to pay their bills, you're talking about their food and their rent check. You know, some of us could take a 2-week holiday, but there's tens of millions who can't do it.
The reason why we're talking about this and seeing this in the market is this is starting to happen already.
It is, but we're going to ease into it, because if we don't ease into it and manage it with good leadership and get the full sector's involvement, we're going to have even worse problems. Overreacting is not a winning strategy. You look at the Fed, you look at what the U.S. government's doing, look what HHS is doing. They're actually doing the right stuff. They're figuring out how to flatten this curve, and they're figuring out how not to panic people. But the markets basically look at the curve globally and say, wow, look at these number of cases. This is not a drill. It's real.
You raised the issue, and I've talked to a couple of people who are in the hospital business in the past couple of weeks, and they are very, very, very freaked out. That there is not
we have 300,000 empty beds in America. That's it. You can fill 300,000 empty beds in no time at all. That's all we have.
And we have something like 100,000 respirators or something like that. And that may not be enough.
Look, it's going to be enough if we flatten the curve so that the elderly and the people who are most vulnerable can get service.
But what does that look like? So far we haven't yet said we should be taking additional steps. What additional steps do you think would be prudent to make sure we don't overwhelm the healthcare system?
Actually, we are taking additional steps. We're confronting the new reality. We're telling people, if you're not well, stay home. Pay attention to washing your hands. Don't go to crowded places. We're not having an NBA. We're not having the March Madness. Those are real steps. Those spread virus. If we moderate the large crowds, if we moderate carefully, but we don't shut it off, guess what? We slow this thing down. Maybe we'll get lucky and the warm weather will slow it down a little bit before the winter. Maybe we won't. But we're doing the right things to slow it. That's the right steps. There's not a medical step we can take today, but we can train our medical system. We can make sure our low-income people who might be cleaning at the hospital don't come in if they don't feel well, if we can give them a paycheck. If we give those people a way to stay alive, paycheck to paycheck, then they won't come in. That's the smart move. HHS and others are actually working on it.
I know, but we got to get them in there.
Thanks very much, Jake.
Well, I wish I had better news, but that's the news.
No, absolutely. Jay Walker, we really appreciate it, co-founder of Priceline. We've got some breaking news, in fact, out of New York City. Let's go to Julia Borson. Julia, what's happening?
Kelly, New York will ban gatherings of more than 500 people. That's including Broadway shows, and they're going to be restricting smaller gatherings. Now, the ban will begin at 5 p.m. tonight for Broadway theaters with a capacity of more than 500 and will go into effect for other venues starting Friday at 5 p.m. Governor Cuomo tweeting out that they're taking new actions to reduce the density of people across the state. Starting tomorrow night, gatherings with 500 people or more will not be permitted in New York State. Additionally, for facilities with an occupancy of 500 or fewer, they are reducing the legal capacity by 50%. Kelly, back over to you.
Wow, huge moves. But like we were just discussing, perhaps no move is huge enough to really contain this. Julia, we appreciate it. Thanks.
All righty. Verizon announcing a short time ago that it will accelerate network investment and capital spending by as much as $1 billion, upping guidance from 17 to 18 billion to 17.5 to 18.5 billion in outlays. With so many people starting to work from home and stresses on the system from government and public safety agencies, Verizon is now spending more to upgrade its systems. Joining us now is Verizon's chairman and CEO, Hans Vestberg. Mr. Vestberg, welcome. Good to have you with us.
Thank you.
Obviously, as more people work at home, in whatever the business may be, there's going to be a need for more connectivity. As more people spend time at home and maybe do their shopping online, or they spend time watching Netflix and so forth, I can imagine that the stresses on a network like yours amplify a little bit. What can you tell, and how can you reassure people that your company is ready for whatever stresses could come?
First of all, I mean, so far we have not seen any measurable increases on our data in the networks. We already have a very robust network, but of course we're monitoring that every day. And as you mentioned, more and more people are working from home. Schools are closed. Of course, we think about that, but we also think about all critical infrastructure in the country, of first responders, and of course the healthcare system that is extremely important. So I think all in all, so far we haven't seen any major or measurable impacts on our data growth in the network, but we're monitoring it 24/7 because patterns can change when it comes to capacity, and we need to be prepared for that in order to deliver this critical infrastructure in times like this.
Yeah, and you're obviously in the middle of a 5G rollout nationwide. I just got a 5G phone. The network is trying to catch up with that. But as you look forward, you must be spending a tremendous amount of time thinking about these network capacity issues, number one, but also about your vast workforce. How much of your time and your personal bandwidth and your company's bandwidth is being devoted right now to this kind of virus disaster planning?
The first priority is, of course, the safe and healthy of our employees, our partners, and our customers. And of course, we spend a lot of time on that to talk to our employees, be very clear on communication. We actually have a 24/7. This is, for example, an emergency operations center that we have across the country where all information comes in and we have one way to communicate. That's very important. So, of course, we spend a lot of time on that. But we also spend a lot of time to follow the network to see what's happening in the network. I mean, so far, I'm really pleased with how the network is performing, and it has been in all the major crises we have seen the last decades, that the network of Verizon is always up to that standard and resilient. We're going to do everything to have this critical infrastructure ready and prepared going forward as well, and that's what we're doing. And of course, the leadership team of my company are spending time on it, but we also split the responsibility very clearly in times like that, so we can have people working with business, working with our employees, working with the society, and of course working with our customers, because that's what it's all about, to see that you're actually managing all those stakeholders in a crisis like this.
And Mr. Vestberg, I want to make sure people understand the significance of having you on with this announcement too, at a time when we're talking about companies cutting capital spending, taking other drastic measures. You're increasing your capital guidance range. I would imagine you might even need to add workers. I mean, you tell me, but the bottom line here is that this is economic activity shifting from travel onto, let's call it the invisible infrastructure. Can you guarantee that your rails are going to be ready to handle no matter the increase, the surge in traffic you're going to be dealt with the next couple months?
We have a very strong network, and we continue to build it. And as I said, we will continue to add infrastructure on top of it. We have great capacity in it. So far, as I said, we haven't seen any measure